We were discussing the option strategies in the previous classes. In continuation with that, now we'll deal with collar. Collar is nothing but it's a boundary. Should not be more than this and should not be more or less than this. Our result should be anywhere between these two. Level will be discussed in collar. Limits the value of the portfolio held within two bounds. Within two bounds is the collar. Buying put and writing call. You buy a put. Okay, buy a put here. So buying a put, it's a long position, and writing a call means selling or short of call. But the strike price for these two almost closer or equal value. The relatively writing call at the relatively same strike price for both options. The premium paid for the buying of put option, we need to pay the premium, say around 10 rupees assumed, and offset with the premium received for short call. For the short call, we have received the premium, right? So as we have sold this, assume that it may be around 5 rupees. So we are paying only 5 rupees. By reducing our payment for the premium this way, our income will be anywhere between the higher bound and lower bound. Is that okay? That's a case you have to keep in your mind. And further example is also there. And bull call spread. Bull call spread. Bull represents a positive market. Is that okay? Usually it is a vertical spread. Moderately bullish means we use that bull call spread. In bull call spread, we purchase the call option at a lower exercise price and sale of call option at higher exercise price. For X being 100 and X being 110, we purchase the call option with the lower exercise price. Here we are going to purchase long call European. Here short call European. Is that okay? The same underlying assets. So it seems to be a vertical spread. You are aware about that, what is called vertical spread, right? This is what about the time. This is what about the amount or exercise price. If the exercise price may be 90, 100, 110 and period may be 1 month, 2 months and 3 months. With that same 2 months expiry period, for exercise price of 100, I purchased one call option and at lower rate. Lower rate is nothing but purchasing long position of that, and for the higher rate I could have sold it. So the two call options will have in the same vertical line in the diagram. That's why it is called vertical spread. Is that okay? Same underlying stock with same expiry date. And bull put spread, okay, where put is for safeguarding your position. So put is always meant for the moderately bearish environment, and where we can use that vertical spread. Just the inverse of the bull call spread. Purchase put option at a lower exercise price and the sale of put options at a higher exercise price. Okay, bullish. Remember, in the case of bull, purchase at low, sell at higher. But if it is a put, this is put here. And in the case of bull, purchase at lower and sell at higher, right? In the case of call, it is related to the call, right? So this bull call spread will be suitable for moderately bullish market. Bull put spread is suitable for moderately bearish market. Is that okay? Now bear call spread. This is moderately spread, just reverse of the bull call spread. Bull call spread, and it is just reverse of that. Purchase call options at a higher exercise price and sale of call options at lower exercise price. What you studied in bull call spread will be just applied here, but in a reverse case. Higher rate will be purchased and lower rate will be sold, as it is a moderately bearish. And another one is bear put spread. Bull put spread, I just explained what is called bull put spread. Here it's a inverse of that. Purchase at a higher exercise price and sell at a lower exercise price. So these are the option strategies we have. And of course there are some other variants also, like the straddle and strangle. These are the tailor-made strategies for volatile situations. In the case of volatile situations, already predetermined strategies available. You can blindly follow those strategies, either straddle and strangle. And here we have the long straddle. Long straddle, you may understand easily. Long is nothing but buying. Buy a call and a put option with the same exercise price. You are buying a call as well as put. Okay, in the case of long straddle, you are buying call as well as put for the same exercise price. And in the case of short straddle, it's a difference. Sell a call and a put option, right? Short means selling, right? By selling a call as well as put, it's a mixture of call and put comes under straddle, right? In case of long strangle, this is not straddle, it's a strangle. In case of strangle, purchase a call and a put option with a different exercise price. So in the case of straddle, same exercise price. In the case of strangle, you are buying call as well as put at a different exercise price. And short strangle is the reverse of that. Rather than purchasing, sell a call and a put at different exercise prices for that. And very famous option strategies expected in your examination is the butterfly spread, where asset price is not too volatile. If the asset price is not too volatile, it may be anywhere between a small range, then we can apply that butterfly spread. And the profit and loss under this is limited. High transaction cost. Anyhow, your profit and loss limited because of the high transaction cost. Again, we have long butterfly spread as well as short butterfly spread in that. Is that okay? Both we have. In the case of long butterfly spread, buy one option at each of the outside exercise prices and sell two options at the inside the exercise price. If the exercise price may be 100 rupees and strike price at the each of the outside exercise price, probably 90 and 110, and two options at the inside the exercise price. Is that okay? One option at each of the outside exercise prices and another one is two options at the inside exercise prices. That's how they will plan. So 10 rupees, 20 rupees, 30 rupees. Okay, they will purchase these two options and they will sell these one option of this one option of this one, and they will do purchasing of two options of this one also possible in the case of long butterfly spread. In the case of short, it's nothing but just selling. That's all. So the butterfly options, if you are plotting that, then that will appear this way. Okay, your loss is minimum. This will be the maximum loss possible, and your return is almost standardized with this limit. This is what about your profit. The maximum loss you will face at in this period only. That too. This is the maximum loss, and we have of course inverse butterfly shape also. In the case of inverse butterfly shape, your loss is restricted, but sometimes the gain may be more than a limit. So you are confirming that this is your loss, otherwise payout, and because of that payout, you have the chances to reach so much of gain also. So the investor may either plan for inverse butterfly or inverse butterfly logic. So this is the butterfly logic, this is the inverse butterfly logic. So these are called the butterfly spreads here. Now, mixed strategy, we have the collections of all the items here, so those things are studied under this head. So with that option strategies theory part is over. You can easily cook up the payoff table for each and every options as per the questions design. Now let's see the swaps and swap sensor. Okay, where I'm going to start with the interest rate swaps. Okay, so in case of interest rate swaps, two parties are borrowing the loan, where the interest payment may be two different varieties of interest payment. The interest may be payable either in fixed form or floating form. Fixed form is nothing but the interest rate will be calculated based on the initial loan borrowing. Floating is nothing but whatever the amount repaid, whatever the amount left over after the repayment, for that only you have to pay the interest, which is called floating. Okay, so we have fixed as well as floating. These are the two methods of interest rates applicable. Is that okay? Two methods of interest rates are applicable here. Okay, and one fellow who is in need of a fixed may be offered with a floating rate with much cheaper rate, and another fellow who is in need of a floating rate offered a fixed rate with much cheaper. So he has no other option, he has to go for fixed. But can we exchange those things? Yeah, of course we can exchange those things also under interest rate swaps concepts. Right. Company A has outstanding debt on which it currently paid fixed rate of interest at the rate of 9.5%. So company A currently pays fixed rate. This is what about the current scenario. The company intends to refinance the debt with a floating rate of interest. So what is their requirement? Their want is floating rate. The best floating rate it can obtain is LIBOR plus 2%. The amount offered to them is float plus float rate. is LIBOR plus 2%. LIBOR is the interbank rate fixed by the London government. LIBOR in India, it's an RBA rate, right? London interbank offer rates, right? LIBOR and LIBIT. Similarly, in India, we have RBA rate. Whatever the RBA rate fixed, automatically from there, some margin is fixed by the banker as per their need. Similarly, here LIBOR plus 2% will be taken. So, float, the bank offer will be float is equal to LIBOR plus 2%. However, it doesn't want to pay more than LIBOR, but their interest is to pay only LIBOR only. So they want to pay 2% lesser. Is that okay? That's what about their expectations. The company A currently having fixed rate of interest wanted to switch to floating rate, but they want to pay only float rate, means LIBOR rate for the floating purpose. But the banker offering them only LIBOR plus 2%. Well, if the LIBOR fixes 10%, A company has to pay 12%. But A company wants only 10%, which is equal to the LIBOR rate. That's how they want 2% savings in the case of A company. And another company B is looking for a loan at a fixed rate of interest to finance its exports. Okay, another company B is there. Okay, their expectation is what? Their want is fixed rate. Anyhow, the best rate it can obtain is 13.5%. As B's case, fixed rate, the interest offered by the banker for them is 13.5%, but it cannot afford to pay more than 12%, but their interest is only 12%. This is what about the bank offer, this is what about their expectation. However, one bank has agreed to offer finance at a floating rate of LIBOR plus 2%. Citibank is in the process of arranging the interest rate swaps. Anyhow, for the B company, one banker is ready to offer LIBOR plus 2%. LIBOR plus 2%. So the current scenario is for B company, LIBOR plus 2% will be available. In the case of A company, current situation, fixed rate 9.5% will be available. And Citibank is there to think over how to manage this swap points. It's very simple. Now, you just think over company A, what is a fixed rate and what is a floating rate. What is a fixed rate and what is a floating rate. So I'll write this way, fixed rate and floating rate. Okay, for company A and for company B. For company A, the fixed rate is currently the base fixed rate of 9.5%. And floating rate being, the floating rate it can obtain is LIBOR plus 2%. LIBOR plus 2%. Is that okay? And similarly, another company B, for him, the fixed rate offered will be 13.5. Bank offer will be 13.5, as well as the floating rate they are now paying is LIBOR plus 2%. LIBOR plus 2%. Now find out the difference. The difference between these two is 9.5% and 13.5%, 4%, and this will be LIBOR plus 2. This is also LIBOR plus 2, 0. So 4% will be the benefit we have because of shifting. That 4% will be shared among the three parties. Who are they? Company A, company B, company C. That's how we can easily understand. Okay, what is the fixed rate offered for A and the fixed rate offered for B, and the difference will be taken, as well as floating rate for A and floating rate for B, and difference will be taken. The net difference will be the savings if you are doing the options. I mean swaps, interest rate swaps. Okay. Now what happens? The bank offered for A companies LIBOR plus 2%, and they want to pay only LIBOR, so they want at least 2% savings, right? Out of 4% savings, can we offer the 2% savings to A? Of course we can offer. And what about the B's case? The current situation being they are paying floating rate where LIBOR plus 2%. What is the bank offer for them is fixed plus fixed rate 13.5. What is their expectation is fixed rate at the rate of 12% only. Bank offers 13.5, but B company wants only 12%. So they want a savings of 1.5%. Out of 4% of savings by swapping, of course 1.5% decent share will be given to B. Even after giving this, whatever the amount left over is around 0.5% will be taken by Citibank, the mediator. Citibank will be taking care of this. That's how the swap points is offered. How the swap points is offered is very simple. Let's see here. In current position, whatever the rate is offered for A and Co, they will continue to do the same way. Okay, they continue to do the same way, but the A company will make the payment to the Citibank. So let me explain that in detail so that you will understand. So in the picture you will understand easily if I start draw once again. Is that okay? Let's see here. Now A company and B company and Citibank. Now listen, what is offered to A will be taken up by the party. A is offered with fixed rate. Okay, fixed rate. Currently they are offered with the fixed rate, and they want what? Floating rate. They want floating rate. And B is offered with what? B is offered with floating rate currently. And the company A has outstanding debt on which it currently pays a fixed rate of 9.5%. The amount payable for that is 9.5%. And the company intends to refinance the debt with a floating rate of interest that we will discuss later. And in the case of B, another company B is looking for a loan at a fixed rate of interest. Their interest is fixed rate, but anyhow they are offered with a floating rate. The best rate it can obtain is 13.5%. We will deal it later, but it cannot afford to pay more than 12%. However, one bank has agreed to offer the friends at a floating rate of LIBOR plus 2%. For B, LIBOR plus 2% is offered. This is what about the interest rate offered. A is offered with a fixed rate of 9.5%. B is offered with a floating rate, the rate of interest being LIBOR plus 2%. But both the parties are not in need of that one. But Citibank, whatever the things you get, you just take up. And for that, whatever the interest you have to pay, don't bother about, I will pay. So Citibank makes a payment of this 9.5%. So that 9.5% will be payable by A and Co to the banker. Okay, so the amount payable by A and Co as per his own selection of rate of interest, fixed rate of or floating rate. So here A company has chosen fixed rate of interest as per the guidance of Citibank, and as the loan is taken as per the guidance of Citibank, and Citibank remits the interest on behalf of A company. So Citi company pays the interest rate to A company, and A company makes the payment to the banker. And similarly, B company takes the floating rate, as they are not interested to take the floating rate, but as per the choice of Citibank only they have taken. So that will be now settled by Citibank. So Citibank says, don't worry, I will pay that. So LIBOR plus 2% is paid by Citibank. Whatever the interest rate A or company B prefer should not be offered to them. They have to choose the other one. So A prefers floating, doesn't matter, whatever you prefer, you have to choose the other option only. Similarly for B, whatever he prefers, we should not allot them. So he has to take the other one as per the mediator's guidance. And as they have not chosen this type of borrowing, and any commitment for that by way of interest will be remitted by the Citibank. So A company has chosen fixed, should not be choosing, but he has chosen fixed rate of interest as per the Citibank's guidance. Then interest for that will be payable by Citibank, as well as Citibank also makes the payment of LIBOR plus 2% to the company company B, as the company B has chosen that as per the guidance of the Citibank. Is that okay? Now remember, fixed A company will remit to Citibank what they expect, or what they want. For that interest will be payable by A company to Citibank. A company wanted LIBOR rate. That too, the LIBOR rate should be LIBOR plus 2% is offered to company A. However, it does not want to pay more than LIBOR. You want only LIBOR? No, you pay only LIBOR. Okay, don't worry about that. See, A company is now guided by Citibank to accept the fixed rate of interest loan. So A company has accepted for that, and for that any interest payable is paid by Citibank. And A company makes the remittances as per its want. Its want is nothing but LIBOR. So he makes the payment of LIBOR rate to Citibank. And B is also making the payment to Citibank as per B's choice. What is the B's choice? So it cannot afford to pay more than 12%. They want fixed rate, and that too it should be 12% only. That's how they are making the payment. Now come on, tell me what is the payoff here. A company makes a payment of 9.5%. For that 9.5%, Citibank has remitted 9.5%. So it is 0. And A company makes a payment of LIBOR only. And in case of a B company, they have to pay the LIBOR plus 2% that is collected from Citibank. So these two are offset. So no need to worry about that. For the B company, the real payment is only 12%. Is that okay? As per A's demand, LIBOR is going to be the ultimate interest, and as per the B's intention, their payment of interest will be 12% fixed only. Then when it comes for the Citibank, okay, these two are the payment, these two are the inflow, right? So 9.5% outflow, 12% inflow. So net will be 2.5% inflow, and here LIBOR outflow and LIBOR plus 2% is outflow. This is inflow, this is outflow. So LIBOR minus LIBOR plus 2% is minus 2% is the outflow for him. So if you are summing that, then this will be nothing but 0.5% is the revenue. So for the A company, LIBOR is the rate payable. For B company, 12% is the rate of interest payment. For Citibank, a nice swap income is there, 0.5%. A actually expected LIBOR, but they are offered by the other bank LIBOR plus 2%. Because of that, the A company saved 2%. B company actually expected 12% of fixed, but the banker offered 13.5%. But as they expect only, they are paying 12%. So 1.5% is a gain for him. So A is also benefited, B is also benefited, Citibank is also benefited by doing this swap options. That is explained in detail in this picture. Is that okay? Now let's see here. In short, you can do this way. So I have given the complete setup here, but anyhow you can work out this way. Company A's fixed rate is 12%. Company B's fixed rate is 13.4%. Take the difference between these two, which is 1.4, and here LIBOR plus 0.1, LIBOR plus 0.6 is nothing but 0.5. If you neutralize, then the net gain could be 0.9%. That 0.9% can be shared among the three parties, company A and company B. Another one is the party who is doing the swaps, okay, probably banker. The company A requires a floating rate of loan, company B requires a fixed rate of loan, and design a swap that will net a bank acting as an intermediary 0.1% per annum, which will appear equally attractive for both the companies. So what happens here? Okay, this will be shared among the three parties. One is for the banker will take 1%. Balance 0.8% is there, that will be shared among the two parties. 0.4% for company A and another 0.4% for company B. Is that okay? Now listen. And what is the expectations of company A? Company A requires floating rate of loan. Company A requires floating rate means they will be charged with a LIBOR plus 0.1%. But anyhow, there is a savings because of swap. 0.4% savings is shared by the banker for swapping. So for LIBOR plus 0.1% is actually offered to him, but anyhow he gets a savings because of swap 0.4%. Ultimately, LIBOR minus 0.3% will be the net cost for A. Okay, LIBOR minus 0.3% is the net cost for A. Similarly, B requires fixed cost. The fixed rate of interest is 13.5%. Anyhow, out of 13.5%, 0.4 is the savings, and if you subtract that, so 13.1% is the ultimate payment here. So the ultimate payment for him is also 13.1%. Is that okay? So 13%. This is 13.4, right? Okay, 13.4 minus 0.4. 13% is the ultimate payment here. Is that okay? So here what happens? Company A also saved by 0.4 and company B saved by 0.4, and the banker enjoys a benefit of 0.1 because of doing the swaptions, right? Then one more illustration is also similar to this one. Now we'll be dealing with the interest rate caps, floors and collars. Interest rate caps, floors and collars. Caps, the interest rate should not be more than a limit is called caps. Floors, interest rate should not be less than a limit is called floors. Collar, it's a restrictions in both the side, upside and downside both. So the rate of caps, especially caps will be used. Caps will be used when we are making the payment of interest. If I am making a payment of interest as per the floating rate, that rate may go even 11%, 12% and 13% so on. and if the rate of interest payable will be increasing, then it will be a shock for me. As a borrower, I have to pay 10% rate of interest is acceptable, but 11, 12, 13% will be very dangerous for me. So I want to freeze that rate, freeze the rate. It should not be more than 10.5%. Such a way I can freeze that by entering into an option which is called caps in this case. And if I am getting the revenue, I have 1 crore rupees after my retirement, I deposited in the bank to get the interest periodically for my retirement benefits. Like suddenly that interest rate maybe 10% decreases to 9%, 8%, 7%. What happens? For 1 crore, 10% maybe 10 lakhs in a year. If it is only 7%, it's only 70. It may be 7 lakhs in a year. Hardly it's only 50,000 rupees per month. Like I cannot afford my living with the 50,000 rupees amount. So I want to freeze this. It should not go beyond below 9.5%. That's how I can freeze that. That will be called as floor. So cap is nothing but freezing the interest rate not go beyond a limit, and floor is nothing but freezing the rate of interest not go below a certain level, right? Now I'm going to discuss with the interest rate caps. A company has borrowed 1,000 lakhs on floating basis for 3 years. The interest rates are reset every year. The spread over LIBOR is 25 basis points. So what happens? Whatever the rate fixed by LIBOR, with that 0.25% will be addable. 25 basis points is nothing but 0.25%. 1 basis point is equal to 0.01%. You understand that? The company buys 3-year cap and a 1-year LIBOR with a strike rate of 9%. So LIBOR should be 9%. This is the strike price, strike rate, strike rate, and having the face value of the same 1,000 lakhs. The cap carries a premium of 2% of the face value at 20 lakhs. Okay. So what happens? We are making a payment of 20 lakhs as a premium for 3 years period. Otherwise, I am making a payment of 6.67 lakhs being the premium over the period. So that's what about the amortization of the premium. For entering into the cap option, I am purchasing the cap options, right? For purchasing the cap option, I am paying around 20 lakhs rupees. For that 20 lakhs is not for 1 year, it's for 3 years. Roughly, it may be 6.67 per year. So I can amortize that over the 3 years period, 1, 2, 3. Is that okay? Now, the strike rate is 9%, right? Now, what happens? The current year LIBOR is 9%, and if the LIBOR at the end of first, second, third may be 9.5, 8.5, and 10%. Is that okay? How much I have to pay the interest? I have to pay the interest as per the terms of agreement with the borrower, with the lender, which is 25% basis points over the LIBOR rate. So it means the very first year the LIBOR rate may be 9.5%, means my interest rate being 9.75%. In the case of 8.5, I have to pay interest at the rate of 8.75%. Whatever the LIBOR fixes, with that 0.25% will be addable. Here 10.25% interest will be payable over the amount borrowings. So for 1,000 lakhs, 9.75% is nothing but 97.5 lakhs is the interest amount payable in the very first year. Second year 87.5%, 87.5 lakhs. Another one is 102.5 lakhs. So I hope so you could understand these two, that the premium as well as this one. Now, what's the benefit because of this cap option, sir? Whenever the LIBOR rate is more than 9%, that excess over the 9% will be payable or receivable from the cap buyer. The cap buyer means cap seller, the cap writer, right? The cap writer will pay me. Here 9.5% is the LIBOR rate, but 9% will be the LIBOR rate as per the strike rate. If the actual rate is more than that, then definitely I will demand, sir, pay me as your guarantee. You guaranteed me that the LIBOR rate should not be more than 9%. Today the market rate is 9.5%. So 0.5% extra is there. Now you have to make that payment of 0.5%. In the next year again, 8.5%. And where the 8.5% is less than strike rate, definitely I don't get anything. The third year, 10%, which is 1% more than the call option. So definitely the excess over the 9% will be recoverable from the call writer. Okay. So 0.5% on the 1,000 lakh will be 5 lakhs is the revenue for the first year. And the second year I don't get any revenue. And third year 1% over that. So which is 1% on 1,000 is nothing but 10 lakhs. The ultimate cash outflow for me is I received 1,000 lakhs as my revenue in the zeroth period, I have to repay that in the nth period. In the very first year, the interest payment being 97.5 and amortization of the premium expenses for the caps is also 6.67 can be deductible. And of course, because of the call option, I get a revenue of 5 lakhs. So this 5 lakhs can be adjusted. So after adjusting, so 99.17 is my outflow. In the second year, the rate is very lesser, so 87.5, and amortization expenses also my expenses. I add up these two. Of course, I don't get any revenue from the caps, so that the ultimate payment being only 94.17. The third year, my interest payment is 102.5. Of course, I have to adjust the premium paid for caps, and I get the revenue because of the caps of 10 lakhs rupees. After adjustment, 99.17. See now, the LIBOR rate even 20%, I never bothered because I'm able to get the corresponding amount from the caps. After that, my ultimate cash outflow will be 99.17% lakhs only for my entire borrowings. My overall interest payment is now limited to 99.17. Of course, sometimes it may go lesser. If the LIBOR rate is less than 9%, I'm pretty happy. My cash outflow will be lesser. If the LIBOR rate is more than 9%, of course, by the time I'm not going to pay more than 99.17 because whatever the amount I supposed to pay beyond LIBOR rate is recoverable because of the cap option. This is called caps. This is called caps. Now, floors. As already told you, floor is for investors. Right. If the return on the investment is less than the number fixed by them, they can get from the floor options. A fund manager has deposited 1000 lakhs on a floating basis for 3 years, which pays LIBOR plus 50 basis points. So as it's now, we get LIBOR plus 50 basis points. Okay, basis points. Is that okay? It means whatever the LIBOR rate, with that 0.5% will be addable. This is what about my revenue currently. I don't bear if the loss or if the interest recoverable is less than that, a certain limit. So that's why I enter into the floors. The interest rates are reset every year. The company buys 3-year floor on a 1-year LIBOR with a strike rate of 8%. So LIBOR strike rate being 8%, right? So if the interest rate falls below 8%, I will be getting the compensation from the floor writer. Is that okay? So when the interest rate falls below a limit, I am getting the money, right? 1000 lakhs. The floor carries a premium of 1.5% of the face value of 15 lakhs or 15 lakhs or 15 lakhs. So the premium being 15 lakhs or 1.5% on the face value. So 1000 into 1.5 is 1.5% is nothing but 15 lakhs. So the 15 lakhs is the premium payable. Then the term is around 3 years, right? So I can divide that by 3 years. Every year I'm going to amortize the premium payable for floors, right? So 5 lakhs, 5 lakhs, 5 lakhs. Amortization is over. The current 1-year LIBOR is 8.6. 1-year LIBOR is 8.6. And second year, current year is 0, right? 0 year. And if the LIBOR at the end of first, second, third year being 7.5 and second 9%, third 7%. How much will you get as an interest for your investment? LIBOR plus 50 basis points. So you'll be getting 8% here, 9.5% here, 7.5% you will be getting, right? So 8% on 1000 being 8% on 1000 being 80, right? And 9.5% of 1000 being 95 and 7.5% of 1000 being 75 I am getting. Here I am getting very lesser than what my expectation is there. So automatically it will be compensated by floor options. As per the floor option, if the strike price is less than 8%, I will be getting. So here it is less than 8% by 5%, 0.5%, and third year is also less than our strike price of 8%, which is lesser by 1%. I can get these 2% as a compensation from the floor writer. So for the 1000 rupees, for the 1000 lakhs rupees, 5.5% I am able to get in the very first year, which is 5 lakhs, and in the third year I get another 1% on that, which is 10 lakhs. Of course, second year the LIBOR rate is more than the strike price, I don't get anything. So this is the revenue. First year I get a revenue of 5 lakhs, and then the third year I get a revenue of 10 lakhs. The ultimate revenue being 80 plus 5 minus 5, 80, 95 minus 5, 90, 75 minus 5, 70, then you add 10, you will be getting 80. So from this it's very clear, at any cost you will be getting 80 guarantee. In the case of best scenario, you may get more than that also. I'm going to freeze the downfall of the interest amount not below than the 80 rupees. That's why this concept is there. This is called interest rate floors. Interest rate floors. Now, interest rate collars is the summation of these two. So we have both. We have both. Okay. So again, we have to adjust the premium for both and other things also same. It's a combination of caps and floats, so there will not be any confusion. So you can easily understand this one. Now, parallel loan. Parallel loan. Okay. What is called parallel loan? So I am going to explain the parallel loan concept here. Okay. Now, company A wishes to lend 5 lakhs to its Japanese subsidiary. At the same time, B company is interested in making a medium-term loan of approximately the same amount to its US subsidiary. So assume that we have two companies, okay, and in US we have A company, and in Japan we have AS company, okay, B company. In US we have A company, in Japan we have B company. Is that okay? A company wants to lend $5 lakhs to its subsidiary in Japan, and meanwhile that B company is interested in making a medium-term loan approximately same amount to its US subsidiary. So B company has its subsidiary in US, A company has its subsidiary in Japan. So US company wants to lend to its subsidiary $5 lakhs, and B company wants to lend to BS company, means its own subsidiary in US, approximately the same amount in terms of yen. B company being in Japan may have the currency in yen, and US company, A company is in US company, will have the currency in dollar. So they are going to exchange this, right? A will send 5 lakhs to the US subsidiary, rather than A company lends to its own subsidiary. Now the currency swaps. See what happens. A company has dollar. If company A wants to lend to Japan, then automatically A company should convert that dollar into yen. And Japan company wants to lend in terms of yen, but its subsidiary wants the currency in dollar. So it's really another challenge that they have to convert the currency. Why do we want to convert the currency and lend to their subsidiary? So now company A and B will have an agreement. Sir, you lend your currency to my subsidiary, and I will just lend for your subsidiary. That's how they will make an agreement. So A company makes a payment to BS, and B company makes a payment of the same loan to AS company. That's how the thing will be there. And ultimately there will be payment, and all the adjustments will be carried over as per the steps explained here. Is that okay? That's called parallel loan and currency swaps. Okay. So I have given two examples here. And interest rate options is similar. The option is similar, right? Consider a European call options on a 6 months LIBOR, which has an expiry of 3 months. The underlying interest rate is 6 month LIBOR. So here we have the call option for 6 months LIBOR, which has an expiry of 3 months. The underlying interest rate is 6 month LIBOR. This option has a strike rate of 9%. So the call option for LIBOR rate, the strike rate is 9%, has a face value of $5 million, and has a premium of 0.5% of the face value. The currently 6 month LIBOR quote at 8.75. Currently 8.75 is the spot quote, right? What would be the payoff at the end of the 3 months if the LIBOR quotes below 9%, if our LIBOR quotes above 9%? What happens if it is being 10%, and if it is being probably 8%? Is that okay? This is the current scenario. You don't bother about that. So we have a strike price here. So when the LIBOR is more than 9%, okay, it is in the money, we can exercise the option. The difference between these two I will be getting because of the call option. When it is 8%, this is out of the money. Is that okay? This is out of the money. I don't exercise this. Whatever the premium I paid will be my loss. Here, this is the gain. From that gain, I have to subtract the premium. Here, it's already out of the money. Nothing will be gained, and the premium what I pay will be subtracted. That's what about the ultimate loss. Otherwise, the premium will be the loss. Is that okay? LIBOR more than 9%, where option is in the money, and we can make the profit. The profit is nothing but LIBOR minus 9%. Okay, 10 minus 9% is the profit, right? LIBOR rate, whatever the LIBOR rate fixed, probably 10% means 10 minus 9% is my profit. From there I can subtract the premium paid, which is the ultimate profit. In the case of LIBOR rate is less than 9%, I don't get anything, because It is out of the money, OTM, out of the money. So I don't get anything. Whatever the premium I pay is my loss here. Is that okay? So that's how the interest rate options is also understood, right? Now we'll move on to the international operations. International operations, foreign currencies. Direct quote is nothing but it's a quotation for the foreign currency in terms of home currency. Number of units of home currency per unit of foreign currency. Is that okay? The foreign currency should be per unit. For every 1 unit of foreign currency, what could be the home currency payment is required? In India, if we plan to purchase a dollar, how much of rupees is required for purchasing the dollar will be represented as direct quote. In a reverse is called indirect quote. For every 1 rupee, every per unit of home currency, for every 1 rupee, how much dollar will be available, or how much dollar is required for 1 rupee to be purchased in India. In India, then it's called indirect quote. And banker will always purchase at a lower rate per dollar and sell it for a higher rate. That rate at which it is going to be purchased is called bid rate, and the rate at which it's going to be sold will be called as ask rate. Bid rate and ask rate. Is that okay? So for example, direct quote, for every $1 we need to pay 55.50, and for every $1 55.75. What's the two rates are is nothing but the first rate is called bid rate and second rate is the ask rate. Okay, the banker will take up at 55.5, $1 at 55.5. If you want to purchase, the banker will offer you at 55.75. That ask rate is otherwise named as offer price. Offer price. The difference between these two is called a spread. The difference between bid and ask rate is called spread, 0.25. Is that okay? Okay, 0.25 will be the rate here. Now, usually in your examination, this will be quoted this way, 55.50/75. That's how it is quoted in your text in usual manner. So 55.50 plus and 55.75 will be taken. Is that okay? That's how we can decode that. Okay. In case of indirect quote, in India, the denominator value being 1 rupee. 1 rupee of home currency will fetch so much of foreign currency. If you are representing what is the foreign currency requirement for every 1 unit of home currency, then it is called indirect. For every 1 unit of foreign currency, how much of home currency is payable, then it is called direct quote. Hope you could not understand. If in case of conversion of direct to indirect, the bid rate will be equal to 1 divided by ask rate. The inverse of ask rate is the bid rate, and inverse of the bid rate is the ask rate. So these are the basic ideas you need to keep in your mind. And the settlement days in foreign exchange market is given here. You can settle in spot or tomorrow or cash and forward. Spot means the day in which the transaction happened. From there 2 days will be taken care will be taken to finish up that transaction. Tomorrow means if the transaction happens today, then the next day will be delivery date. Cash means the transaction day itself you can get it delivered. So forward is nothing but the transaction date plus number of agreed date will be taken. So this is the number of days you have to keep in your mind for getting the foreign currency you're supposed to purchase. If I want to purchase the foreign currency in 3 months later, then I have to go for forward. I need to purchase the foreign currency now itself, then I have to go for the cash market. In general, in the case of spot market, if I purchase a dollar, that dollar will be delivered in my account only 2 days later. So transaction date plus 2 days. Is that okay? Now, identify whether the following is a direct quote in USA. USA. You are in USA. USA. If not, find it. Okay. So, direct quote in USA. In which country? USA. Then dollar should be in the numerator. Always remember, foreign currency should be in the denominator and home currency should be in the numerator. Is that okay? That's a base. And then the foreign currency should be in 1 unit only, then it is correct. So first case, rupees by dollar. Rupees by dollar is indirect quote. Because we are in USA, the USA dollar should be in the numerator. Here it is a denominator. So it is indirect quote. As it is indirect quote, to convert the direct quote, you have to inverse that. If there is bid and ask rate, the inverse of ask becomes bid, inverse of bid becomes ask. If it is not so, only one rate is given, very comfortable, then you just inverse it directly. So 50 by 1 is inverse like 1 by 5. 1 by 50, then it is 0.02 per rupee. And here dollar by Singapore dollar, right? It is where the dollar is in numerator. So dollar is in numerator, but the dollar should be in terms of one currency, but it is not so. So the dollar should the foreign currency should be in 1 unit, right? Foreign currency should be in 1 unit. Here Singapore dollar is the foreign currency that is not in 1 unit, which is in 1.6. It means it is not in 1 unit. Automatically it represents indirect code. So to make it a direct code, you have to inverse that. So 1 divided by 1.6 will be the answer. 0.625 will be the final answer. And here dollar by sterling, and here dollar is the home currency, sterling is the foreign currency. Is that okay? Foreign currency is in terms of 1, then you don't do anything. This is called direct code. Is that okay? This is called direct code. This is how you can understand very easily. You can keep this point in your mind. Foreign currency should be in 1 unit only, then it is called direct code. If it is not so, you have to convert that. You have to inverse that. While inversing, the bit becomes ask and ask becomes bit. That's all. Now you are given the following spot rates. Okay, DEM divided by Canadian dollar. Okay, Dutch mark. Okay, Dutch mark. DEM is otherwise sometimes quoted as DM, Dutch mark. So 2.2035, 2.2070. This is nothing but bit rate. This is ask rate. Now the above quote is for which currency? Usually the quotation is for foreign currency. Here DM by Canadian dollar, right? DM by Canadian dollar, and 2.2035 divided by 1. So this denominator is the foreign currency. Usually quotation is for the foreign currency, that too in terms of home currency. The home currency is dash mark here, so the quotation is for what? Canadian dollar. So here the quotation is for the Canadian dollar in terms of dash mark is quoted. What is the bid price for dash mark in terms of Canadian dollar? So it is in terms of Canadian dollar, you have to get it, right? So then you have to inverse that. See, as such now it is the quotation for the Canadian dollar in terms of dash mark, but the second question is all about you have to find out the bid rate, bid price for dash mark in terms of Canadian dollar. Then you have to inverse that. You have to inverse that in terms of Canadian dollar. Currently it is in terms of dash mark, so you have to convert that. So then bid price is required. So while inversing, the ask becomes bid. So which is the ask rate? So this is the bid and second one is the ask rate. So you have to inverse that. So 1 divided by 2.2070 will be taken. So that answer, final answer being 0.4531 will be the final answer here. Now question number 3. Given that the bid ask quotes for Japanese yen and Great Britain pound. So Japanese yen, okay, Japanese yen divided by Great Britain pound, which is 210 by 1 and 220 by 1. So it's very clear that it is a quotation for the foreign currency. Quotation for this, and this is in terms of home currency. Denominator is the foreign currency and numerator is the home currency. And you want to purchase GBP. You want to purchase, of course, foreign currency. GBP is the foreign currency. You want to purchase that foreign currency. This is the bid rate. This is the ask rate. If you want to purchase the banker, then banker will offer this rate. So 220 will be taken. Is that okay? And what will be the rate? Rate for A? In the first case, 220 will be the rate. Is that okay? And in second case, sell Great Britain pound. If you want to sell, then this rate will be taken. If you are selling, then the banker will be purchasing. This is answer for A. This is the answer for B. And purchase Japanese yen and sell Japanese yen. So if you are planning to purchasing the Japanese yen, means the Japanese yen should be the foreign currency more, but it is not so. Then what we have to do? Purchase means always we have to take with the ask rate. But here 1 divided by bid rate will be taken because it's the inverse code, right? For Japanese yen, it is the inverse code. As for this purpose, Japanese yen is inverse code. For purchasing, usually we will take the ask rate. While we inverse that, the bid becomes ask. That's why 1 divided by bid rate will be taken. In the case of selling, 1 by ask rate will be taken. Hope so you could understand. Now, question number 4. Question number 4. In question number 4, if $1 is equivalent to Singapore dollar, okay, dollar by Singapore dollar, okay, Singapore dollar by dollar is equal to 1.8344 divided by 1, and $1 is equal to this one, okay, Brazilian real. That this is Brazilian real divided by $1 is equal to 2.4590 by 1, and 1 ruble. 1 ruble is equal to, okay, dollar by ruble, 0.03252 divided by 1. how much is US dollar 2500 worth each of the individual currencies on the spot market. So if I have 2500 US dollar, how much could be the other currency? You just fit into the dollar case, means equal to dollar here. The next one will be calculated as a missing data. Is that okay? I just drafted here as it is, and then I substituted the dollar value being 2500. The other value can be easily found out this way. Is that okay? So here you have to do the cross multiplication. 2500 into this one, 1.833 8344. That answer will be this one. Is that okay? Here 2500 into 2.4590 will be the answer. So final answer is Brazilian real 6,448, and the next case is 2500 should be divided by 0.03252. Here it is a denominator. Okay, this is how we have to get it now. So then ruble 76,875 will be the final answer. So question number 4 is over. Now let's move on to the question number 5. It is given that euro, this much is equal to dollar. Okay, euro by dollar, 0.8730 by 1. Jordan dinar. Okay, so JOD by dollar 1.4092 divided by 1. And Chilean peso. Okay, Chilean peso, CLP divided by dollar is equal to 0.0013616 divided by $1. If we need to buy 8,000 units of each of the above currencies, how many dollar we need to spend? So we are in need of dollar here. If we have the other currency, so 8,000 units of the other currency. Other currency means euro. I need to find out what is the dollar here. I have the other currency of 8,000. I need to find out what is the number of units of dollar required, and I have 8,000 Chilean peso. Okay, Chilean peso. Then how much of dollar is required? Do the cross multiplication. So 8,000 into 1 divided by 0.8730, the value being $9,164 is required. 8,000 divided by 1.4092 Jordan dinar should be in denominator, so that I will be getting $5,677. The last case 8,000 divided by 0.001316, the final value will be 60,79,027 will be the answer. Is that okay? Hope so you could understand. So much of Chilean peso required for getting the $8,000. So dollar is given, the other currency is found out, right? Then sixth one, a German machine is selling at 70,000 euro. What is the dollar price in US? For the German machine, if the exchange rate is 1.2 per dollar. So 1.2 per dollar. Okay, this is euro, this is dollar. Is that okay? Now here we have 70,000 euro. Now we have to find out the dollar value. So how do we get it? So 70,000 divided by 1.2 will be the answer. So the answer is $58,333. And question number 7. A UK investor purchased 91-day instrument face value being $1,000 for 987.65. So what happens now? So he purchased it for $987.65, an instrument, probably a bond. A bond purchased for $987.65, the maturity value being $1,000. Is that okay? At the time, the exchange rate was 1.75 per pound. Okay, at that time. At maturity, the exchange rate was 1.83 per pound. Okay, so dollar by pound value is, currently it is 1.75 per pound, and here it is 1.83 per pound. What was the investor's holding period return in pounds? If you want to find out the returns, you can directly find out the difference between these two is your return, right? So the value being around 12.35 is the return for 1,000 rupees. Is that okay? So 1.235 will be the return in general. But let's see what happens after the conversion. So here we can convert that into dollar. Sterling. To convert that sterling, what happens? So you have 987.65 at the time of investment, and I want the investment value in terms of sterling. So 987.65 into 1 divided by 1.75, the value being 564.37 sterling. Similarly here 1.83 divided by 1, where we get $1,000 here. So we have to do the cross multiplication in term to arrive in terms of sterling. So 1,000 divided by 1.83, if you do so, that value being 546.4. directly if you see that there seems to be a gain, but after conversion you have invested so much but you are getting only so much, so you are losing almost 17.92 being the lesser value compared to the original investment you made. So then it is not profit, it's only a loss. So you can change that, it's not profit, it's a loss in this question number 7. Hope so you could understand. Now we'll move on to the next question. Question number 8. Right. In the interbank market, the Dashmark is quoting at 21.50. If the bank charges 0.125% commission for TT selling and 0.15 for TT buying, what rate should it quote? Okay. So buying and selling. Buying means banker will take. So 21.50. In the case of purchasing, they will deduct the commission, and in the case of sales, they will add the commission. Okay. Okay. They have to add the commission. Is that okay? While selling, they add the commission. So 21.50 is the cost. If you demand, sir, I want the Dashmark, the banker will add the commission and he will sell for this rate. So 21.50, with that you have to add what? Selling commission is, here is selling commission is 0.125% will be addable. So the value being 21.50, and after adding that value becomes 21.527. And buying rate, if you sell for, sir, if you demand while selling to the banker, sir, it is traded at 21.50 in the market, what rate will you take, sir? So the banker will say, definitely I will charge some commission on that. So he will subtract the commission and he takes at lesser value. The commission here being 0.15, so he has to subtract 0.15 from that value. So 21.468 will be the final value. So this will be the ask rate, this is the bid rate. The difference between these two is the spread here. Is that okay? That's how the TT buying and TT selling rates are calculated, right? Now in question number 9, the following rates appear in the foreign exchange market. So these are the rates, spot market as well as 2-month forward market. So these are the rates are available. How many dollars should the firm sell to get 5 crores after 2 months? 2 months later, right? So now it is rupees by dollar, spot rate being 45.80 and 46.05 per dollar, and in future this is 46.50 and 46.47. That's how we can represent. Is that okay? Hope so you could understand. Now this is spot rate, this is future rate, spot and forward rate. Is that okay? How many dollars should a firm sell to get 5 crores? They want the crores rupees. Okay, rupees. Here in denominator, dollar is there. It means this is the foreign currency. Now I'm going to purchase home currency. Otherwise, I'm going to sell the dollar. So selling the foreign currency. Is that okay? Selling the dollar is nothing but what? You have to take the ask rate. You have to take the ask rate. This rate will be taken. Okay, but take the inverse of that. Take the inverse of that. So 55 crores multiplied with the inverse of this. Inverse of this. Otherwise, you can divide this by 46.450. What's the value? 46. Now let me verify this. So how many dollars should a firm sell to get 5 crores? Okay, they want to get 5 crores and they are selling what? Dollar. So as they are selling the dollar, they have to take the bid rate. Bid rate. So bid rate is taken. Okay. So bid rate 46.50 will be taken. How many rupees is the firm required to pay to obtain US dollar 2 lakhs in the spot market? So they are now purchasing the dollar. Purchasing means banker will offer them. So offer rate will be taken. So 46.05 will be taken. Is that okay? And assume the firm has US dollar 50,000. How many rupees does the firm obtain in exchange? So they are selling this. Selling means bid rate. Bid rate will be taken. Okay. So bid rate is this one. 45.80 will be taken. Is that okay? Hope so you could understand. What rate is must? That will be determined. Once you decide what rate to be taken, then there will not be any problem. Is that okay? Now we will move on to the next concept here. Appreciation and depreciation of currency. Appreciation and depreciation of currency is nothing but $1 is say 50 rupees. Okay, rupees by dollar. $1 is 50. If it suddenly increases to 55 per dollar, it means your dollar is appreciated by 10%. Okay, how do we get it? So from 50 to it moves to 55. It means 5 rupees changes from the base of 50. You can represent that in terms of percentage, which is called 10% appreciation. So this is nothing but dollar appreciated by 10%. Dollar appreciation by 10% is equivalent to rupee depreciation by, but not necessarily it is 10%. But anyhow, in CMA book they have considered that the appreciation of dollar is equivalent to depreciation of rupee in the same percentage. But usually it will not be in the same percentage. I just explained in detail how these two will not be equivalent already. Anyhow, just understand that the difference between spot rate and future rate will be the appreciation and depreciation here from the base value we have to take. This is what about the appreciation and depreciation case here. In question number 10, which currency is appreciating and find out the rate of depreciation. So here what happens, I just explained that, right? $1 is 50 rupees and the same $1 is now later it becomes 55. 5 rupees changes from the base of 50 rupees. Then the appreciation of dollar is 10%. So appreciation of dollar is 10%. The appreciation of dollar 10% is equal to depreciation of home currency, means rupees, but not necessarily in the same rate. I already explained in detail along with the concept lecture, but I'm not going to touch that now, right? Because in examination CMA book I referred, they have just followed that these two are same, like no need to worry about that further. Now find out 10% appreciation in dollar. 10% appreciation in dollar means currently $1 is 50 rupees. After appreciation, the dollar will be purchased at higher cost. So rather than 50, you have to pay 55 rupees. Is that okay? And 10% depreciation in dollar. So rather than paying 50 rupees currently, 10% depreciation means you have to subtract 10% from the numerator. If the dollar appreciates or depreciates in the denominator, that appreciation and depreciation will be adjusted in the numerator. Right. So if you think about that, the mobile cost is appreciated by 10% means earlier it is 10,000 means if the mobile price is appreciating by 10% means for the 10,000 you have to find out 10% on that. So for the 10,000, 10% is nothing but thousands. So 10,000 plus 1,000, 11,000 will be the appreciated value of the mobile. That's how you can think over. So here the foreign currency is compared or assumed to be a commodity like. So in the numerator we have to find out the home currency only. When the foreign currency is appreciating, then the home currency payment will be higher. When the foreign currency is depreciating, the home currency payment will be lower. Is that okay? So these are the two items, you have to keep that in your mind. Now, I will go for the question number 12. The dollar is currently trading at 40. Calculate the spot rate in 2 months. In 2 months, right? In 2 months later. So currently it's 40 rupees per dollar, right? And what happens if dollar depreciates by 10%? Dollar depreciates by 10%, means 1 minus 10% will be subtracted, the ultimate value being 36 rupees. So 36 rupees will be a dollar's rate, and dollar appreciates by 10% is also the same. In numerator it will be addable. Now question number 13. In question number 13, Air France has shipped goods to an American importer under a letter of credit arrangements which calls for payment at the end of 90 days. The invoice is the invoice is $1,24,000. $1,24,000, right? Presently the exchange rate is 5.7 French franc to the dollar. Okay, so French franc divided by dollar is equivalent to 5.7 per dollar. If the dollar were to strengthen by 5% by the end of 90 days, what should be the transaction gain or loss in franc, right? So dollar strengthen means you have to multiply with that appreciation in the numerator. So 1.05 will be multiplied in the numerator. After multiplying this, the $1 price in the later period becomes 5.985. Is that okay? So this is nothing but strengthening of dollar. Strengthening of dollar is nothing but weakening of French franc. Okay, weakening of French franc. Is that okay? So that's how we can get that value also here. Clear? And here dollar strengthens by 5%. If the dollar weakens by 5%, what happens? You have to depreciate that. So after depreciation, the value being this one. After appreciation, $1 is 5.70. Because of appreciation, it becomes 5.985 French franc for $1. And for depreciation, $1 is equal to 5.7 French franc depreciates to 5.415 in the later period. Is that okay? Now the effect will be, in the very first case, you thought because of strengthening, you thought you may pay this much because $1 is equal to 5.7 French franc. So you have to multiply the number of dollars with 5.7. You will get the value in terms of French franc. Because of dollar appreciations, you have to now multiply again with this. So this value will be 7,42,140 French franc. So there is a gain. Okay. So as you imported, you are going to receive. If you receive today itself, you will be getting only 7,06,000 French franc. But if you are receiving that sometimes later, then you will be getting 7,42,000. So you are pretty happy that your French franc will be increased by 35,340 because of the appreciation of the dollar. If the dollar is weakening, then you will be losing this much of money. Is that okay? This is what about the question number 13. Now let's move on to the next concept: forward rates and swap rates. Forward rate is nothing but today's rate and tomorrow's rate. So the difference between today's rate and tomorrow's rate is the spot rate, means the forward rate. Is that okay? Now 55.5 per dollar to 55.75 per dollar is the real term, can be represented this way. Is that okay? Now what is called forward? Currently, if you want to purchase the same dollar 3 months later, what is the rate? This is what about the spot rate. This is what about the forward rate. Forward rate is nothing but the rate you are going to book today itself, just similar to the future contract. Currently, the market price of the share may be 55.50. If you want to purchase that same in the future market 3 months later, you may pay something extra. That's something extra because of the holding period costs, like interest and other thing. Similarly, if you want to purchase that today itself, $1 costs 55.50. 3 months later means you can book today itself where it is 56 rupees. So you are going to pay 0.5 extra. Is that okay? Now, today rate is 55.5. If you want to book for purchasing 3 months later, you have to pay something extra. No, if you are supposed to pay something extra, then it is called premium. This is called forward premium. Today the value is 55.50. 3 months later, if you want to purchase, you just pay only 55. You are going to pay lesser. If you plan to pay lesser because of some market arrangements, then it is called discount. So when the forward market price is less than the future, spot rate, then it is called discount. Otherwise, it is called a premium. Is that okay? So the difference between these two, the difference between the spot and forward rate is called forward premium or forward discount, that can be represented in terms of percentage. Is that okay? Now remember, this is the main point to be noted here. Swap points are in increasing. Okay, the swap points are increasing, then the future will be in premium. If the swap points are decreasing, then the future is decreasing, means depreciating and discount. If the swap points are increasing, then the future value forward rate will be higher. If the swap points are decreasing, then the future or either future or forward rate will be in discount. Is that okay? To make you understand that logic, let me explain here. Let's see here. Restate the following outright forward bid-ask quotes in forward points. Also state the bid-ask spread here. Spot rate being 1.3431 and 1.3436. This is the spot rate. 1 month later, they have given the swap points. As the swap points are increasing, means the bid swap points as well as asked swap points. If you compare these two, if these two are in increasing trend or incremental value, then it is called premium. In case of premium, what you have to do is you have to add to arrive the future, because in the future forward rate may be higher than the spot rate. So you have to add these points with the spot rate to arrive the future. So 1.3431 with that 01 will be addable. 01 is nothing but 0.0001 will be addable. So 1.3432 will be the new value and our forward value. 1.3436 with that 0.0006 is added to arrive the 1.3442. As well as here also it is showing increasing trend for 3 months later. This is 1 month forward rate. This is 3 months forward rate. The 3 months forward rate is also showing increasing trend. Increasing means automatically it's a premium. Premium means you have to add that swap points with the spot rate. So 1.3431 with that 17 will be addable to arrive this one. 1.3436 with that 27 is added to get this one. In case of decreasing, what happens now? See, in the case of second case, 43.5850 and 43.5875, the swap points is 200 and 195. As it is decreasing, the forward contract value will be in discount. So as it is in discount, we have to subtract that value here. Is that okay? So 43.5850 from the 200. Whenever the round number is given, the last 3 digit will be affected. Is that okay? You should not subtract from original 43 or point. It's not 0.2. it's 0.02 will be taken, last 3 digit. Here 2 numbers given means last 2 numbers it represents. Is that okay? So here last 3 digits are representing. From the last 3 digits 5850 200 is subtracted to arrive the 43.5650, which is the 1 month forward rate. Similarly 43.5875, from that last 3 digit will be subtracted with 195. After subtracting, the value will be 43.5680. As this is showing increasing decreasing trend, it's a discount. Discount means automatically you have to subtract the spot rate to arrive the forward rate. Is that clear? Hope so you could understand appreciation and depreciation concept here. Now in question number 16, okay, the spot rate of Kuwaiti dinar is 159.24, and then the 3 month forward rate is 162.72. so it is increasing, so definitely it's premium. It is only premium. Kuwaiti dinar is in premium. Determine the premium or discount of dinar with relative to the rupee. You have to show that with respect to the rupee term. Rupee term means you have to inverse that, right? And then you can calculate. So 159.24 and 162.72 in terms of rupee mean you have to do the inversing that. First of all, 1 divided by 159.24 and 1 divided by 162.72. Now we get Kuwaiti dinar divided by rupee. It means this will be the home currency, like, and this will be the rupee will be the foreign currency. So numerator will be the home currency. Kuwaiti dinar will be the home currency, and rupee will be the foreign currency, like. Okay. Now the ultimate value will be 0.00615, and this one will be 0.00628. So here what happens? Now this value is okay. Probably this one is 28, this one is 15. Sorry, this value is decreasing. So automatically then rupee will be in discount, and you can find out the discount percentage also, which is nothing but swap points in percentage. 8.28% is discounting. So always remember these two will not be equal. Already told you, but in CMA book they have considered this being equal only. Okay. Now we'll move on to the next concept called cross rates. In the case of cross rates, how do we calculate? Two different rates will be given, and the common rate will be found out using the common identifiable currency you have. Getting the exchange rate between two currencies using the third currency. Is that okay? So I will go for the comprehensive illustration here. Find the direct quotes of French francs in India. So French francs in India means India should be in terms of Indian currency should be there, and the quotation is for a French franc. The quotation should be in the denominator, and in numerator we need to have the currency. So home currency divided by foreign currency is the format. Here you have to put that same value as in you are in India, or you are going to calculate that quotation all in India. Rupee should be in the numerator, in denominator foreign currency, French franc should be in the denominator. In this case, how can we calculate, sir? See here, so many quotations are given: rupees by dollar, and the dollar by Australian dollar, Great Britain pound, and Australian dollar and Great Britain pound, and French franc is given. See, my intention is to cancel the denominators. Unwanted common currencies are cancelled, so that I will end up with the rupees by French franc. So I have to start with the rupees first of all. So rupees is connected with the dollar, so I put that value this way, so rupee by dollar, and I now need to cancel the dollar. To cancel the dollar is connected with what? Australian dollar in the question. So I have to put the Australian dollar in the denominator. Now I have to eliminate the Australian dollar, because I have to bring the denominator equivalent to French franc. Until the denominator becoming French franc, I have to cancel the denominators by multiplying with the same denominator in the numerator. So the Australian dollar in the denominator is now posted in the denominator, in numerator. Now the Australian dollar is connected with the Great Britain pound. Again, I don't want the sterling here, so the sterling will be cancelled by posting that value in the numerator, and sterling is connected with the French franc. Okay. Now what happens? Very easy. That dollar and Australian dollar and sterling are cancelled. So ultimately you will get rupee by dollar. This is how we can get the answer. Okay. Now we have to get the answer for the bid as well as ask separately for the bid. For bid, we have to take the bid only if this being the same format. If it is not so, you have to take the inverse of ask. So rupees by dollar, of course, rupees by dollar. Then you can take 44.5 04. You no need to worry about that. And the next one is dollar by Australian dollar. Our dollar should be the numerator. Yeah, of course. In the second term, dollar is the numerator. So first term will be taken. 18.05 will be the answer. And next will be Australian dollar should be in the numerator divided by sterling. Here Australian dollar is in the denominator. Then what you have to do? You have to take the ask and take the inverse of that. So 1 divided by 0.4127. I hope so you could now understand the difference. If the value is as per the terms we have used here, then no problem. You can directly take. If it is inverse, then you have to take the inverse of the value. So while inversing to find out the bid, it's nothing but inverse of ask becomes the bid. So you have to take the ask and take inverse of that. That's how you can find out the bid value here. And sterling by French franc. Yeah, of course, it is as per the terms only given, so you no need to worry about that. You directly multiply with this. So 0.0996. So the bid value here be 191.84. Similarly, we have to go for ask rate. In the case of ask, you have to take the ask rate only. This one is going to be inverse, and rest of the things will be the same. So 44.08 and 18.08 into 1 divided by inverse of bid will be taken. So 1 divided by 0.4119 into and 0.0996 will be taken here. Ask 9 will be taken. Is that okay? Okay, 0.0999 will be taken. The final value being 193.29. That's how the cross currency is calculated and taken. Is that point arbitrage? 2 point and 3 point arbitrage. Question 18. Dutch mark spot rate was quoted at $0.4 in New York, and then the pound sterling was quoted at $1.8. So now arbitrage, where in arbitrage we are going to discuss the 2 point and 3 point arbitrage. Okay, in New York, Dutch mark is quoted this way, right? Dollar by Dutch mark 0.4 per Dutch mark, and pound sterling was quoted at $1.8, $1.8 per sterling. This is dollar by sterling. If the pound is quoted in India at 1.85 per pound, in India what happens now? This is in New York. In India, if it is 1.85 sterling per sterling, 1.85 dollar per sterling, what you can do? You can purchase from New York market and you sell in Indian market. So you can make a nice profit of 0.05 per sterling. If you purchase 1 million, so you multiply with 1 million, so you will be getting so much of profit. This is called 2 point arbitrage. Buying in one location and selling in another location is the 2 point arbitrage. Is that okay? Now, what should you expect the price of the pound in terms of Dutch mark? That's normal. I skip that. If the pound was quoted in French franc, Frankfurt, at Dutch mark being 4.4 per pound, 4.4 per pound. Okay. What would you do to profit from the situation? So here what happens now? This is the number 1 rate given, and in New York what happens? Dutch mark spot rate quoted at $0.4 in New York, $0.4 per Dutch mark, and pound sterling was quoted at $1.8, dollar by sterling, 1.8 per sterling. Is that okay? Now what you can do is 3 point arbitrage will fall here. Okay, 3 point. 3 point is nothing but, you can assume this is one quote, DM by sterling, and Dutch mark by sterling can be arrived by doing the cross currency for these two. Okay, so here what happens? DM by sterling can be calculated, where dm is linked with the dollar and dollar should be cancelled, so dollar by sterling. This is how we can use the cross currency. It's not necessary that you have to go with this only. You can do this way also. You can calculate the cross currency between these two to find out the value for this one, dollar by sterling, using the cross currency. It's your choice, or you can keep this as a base and find out the cross currency by multiplying these two. Also it will work. Now I'm going to find out the cross currency between Dutchmark and sterling using these two factors. So dm by sterling is equal to dm by dollar and then dollar by sterling. Here dm by sterling is not directly given, so it is indirect quote, so I have to inverse that. So 1 by 0.4 will be taken. If there is bid and ask rate, while inversing, the bid will be equal to 1 divided by ask rate will be the answer. But here only one rate is given, so you no need to worry about directly you can use. And dollar by sterling, it's directly given, so 1.8 divided by 1 will be the value. If you do the cross multiplication, the ultimate value being 1.8 divided by this is not 0.04, this is 0.4, okay, divided by 0.4, okay, the value being 4.5. So from this it is very clear, Dutchmark by sterling in direct currency being 4.4 per sterling and 4.5 Dutchmark per sterling in cross currency. Definitely you can buy a sterling here and sell here, will give you a profit of 0.1. Is that okay? That's how we can get it now. So you can get this answer. This is called 3-point arbitrage. So we have 2-point arbitrage as well as 3-point arbitrage. Now let's move on to the next illustration. The same 2-point arbitrage and 3-point arbitrage is there. Determine if there is a spot arbitrage opportunity among each of the following two sets of spot rates. Next, to show how an investor can take advantage of it if there is one. If there is such an arbitrage, assume that the dollar is your home currency. Then you assume that this is your home currency and this is the base, dollar by Dutchmark. And you have to find out the cross currency for this. Is that okay? So for the cross currency of dollar and Dutchmark, I am going to use this one, is equal to yen by, here dollar by Dutchmark I need, so dollar is connected with what? Yen, and then I have to cancel the yen, so yen divided by Dutchmark will be taken. So dollar by yen here is 120 yen in inverse, so I have to do inversing that, so 1 divided by 120 into yen by Dutchmark, it's clearly given, so 65 will be the answer. Is that okay? So 65 divided by 120, 65 divided by 120, the final answer be 0.5417. Here 0.554 in US 0.554 will be the dollar for every Dutchmark. In cross currency other than US 0.5417 will be the value here. The difference between these two is your gain. Okay, so 0.554 minus 0.5417 will be the gain. So 0.0123 is your gain. If you start with this amount, okay, if you start with this amount and you will end up with this amount, that's a gain. Okay, the difference between these two is your gain. You can find out the gain percentage. So 0.0123 is nothing but difference, and the base will be 0.5417 will be taken. So 0.5417, the value being 2.27%. Directly you will get it here. And if you want to show that, in a statement like as a step by step, cross rate is lesser than the direct rate. Okay, cross rate is lesser than the direct rate. That means in US you have to this is cost here. So in US you have to sell it. In US you have to sell the DM. Okay, So then what you can do, you can buy the DM somewhere. How can you buy? Dollar is converted into yen and yen is converted into DM and DM is now sold in US. So buy yen using the dollar, where you get $120 yen is required to buying. Okay, you are able to get 120 yen for $1, and using the yen I am purchasing the Dutch mark in another country where it is 1.8462, and then again I am buying the dollar using the Dutch mark in our local place, which is $1.02279. See, I started with the $1 and ended with the $1.02279 in finally. So the difference between these two is the profit. That's how you can think forward. Find out whether cross currency and direct rate. So you have to find out that these two rates and compare these two rates and decide which is the cheaper, and if it is cheaper then you buy there and sell in the other country. Is that okay? So the same way this illustration is also there, you can understand easily. Now the following direct quotes have been observed from the forex market, and of course this is also pretty simple. Rupees by US dollar. Rupees by US dollar. So question number 21. Question number 21. Okay. Rupees by US dollar 43.70, and this is all these things are there. What is required? Indirect quote in respect of 1, 2, 3. Okay. 1, 2, 3. So for all the things you have to find out the indirect quote. So very simple. You have to inverse that. 1 divided by 43.7. That's all. Okay. And forward discount on the Indian rupee. Forward discount on Indian rupee. So you have to find out the discount in Indian terms rupee. Same answer. Already we have seen. And cross rates. Cross rates, rupee by Dutch mark you have to find out. Okay. It's also very comfortable. You can get it easily. As already we have seen these concepts, I can skip this. So 21 is basic one. Now I am going to deal with honoring, cancelling, all these illustrations here. Honoring, cancelling, early cancelling, yearly honoring, all these things are there. SSA Limited on 1/7/2021 entered into a 3-month forward contract for buying Great Britain pound for 1 lakh. Great Britain pound for 1 lakh. For meeting an import obligation. Okay, for meeting an import obligation, it means SSA has to make a payment of Great Britain pound 3 months later. As they have to make the payment 3 months later, by the time that Great Britain pound could have been appreciated, if it is appreciated, then it will be loss for SSA Limited because they have to pay more money. Rather than that, they can go for booking in forward contract itself. So they can plan to go for booking. Explain the further course of actions if we SSA. So these are the different codes given at a different period. Now explain the further course of action if SSA honors the contract on 1/10/2021. So they are entering into the forward contract. So on this date itself, 1/7/2021 itself, they could enter into the forward contract. So they want the Great Britain pound. As they are in need of Great Britain pound, the banker will sell at the ask rate. So ask rate will be 92.30. So for the contract, they have to make a payment of 92.30. Is that okay? So this is the basic illustration. SSA Limited has to pay 1 lakh Great Britain pound in a matter of 3 months later. For the 3 months later, today itself they can enter into the forward contract. Today means 1/7/2021. In 1/7/2021, the 3-month forward rate is 91.90, 92.30. Anyhow, as we want that, it's ask price for us. So 92.30 will be the rate at which it is booked. Explain the further course of actions if SSA honors the contract. Honors the contract is nothing, no problem. They have to make a payment of 92.30 for every sterling. So they will pay 92.30 for every sterling, every Great Britain pound for 1 lakh. They made have paid 92 lakhs 30,000 rupees. Collect the money and settle the due. Second case, cancels the contract on 1/10/2021. On the exact date, it is going to be cancelled. If I want to cancel, the banker will be shocked because I booked with the banker that I will purchase 1 lakh Great Britain pound in a matter of 3 months later. As per your agreement or your requirement, the banker has entered into some contract with third party to deliver 1 lakh Great Britain pound to you by the end of the third month. But if you say you don't know, you don't want. If you say that you don't want, it means cancelling. Cancelling that, then the banker will be shocked. Then the banker has the Great Britain pound now in their hand. They have to discard that Great Britain pound by the time on 1/10/2021. As you don't want to take up that, they have to close that to sell in the local market. In the local market, if they sell, the bid rate will be applicable. The bid rate for them is 92.50. Is that okay? So if you take up, then you can take up at 92.30. If you say that I don't want, then it will be sold in the local market. As it is sold in the local market for 92.50, the difference between these two will be adjusted in your account only. If you could have taken that, you could have taken at 92.30, but it is sold in the market for 92.50. The sale value is pretty higher. 0.2 is higher for every sterling. So as the contract is for 1 lakh sterling, so 1 lakh into 0.2, 20,000 rupees gain is there. So banker will give you 20,000 rupees. So because of cancelling the contract and maturity, you will be getting 20,000 rupees in your hand. Is that okay? And extends the contract for 1 more month. So what happens? It's called rollover or early extension. Otherwise, it is named as early extension. Sir, as my commitment, I have to take the delivery on 1st October. But what happens? Seller extended the period. I want to enjoy that credit period also. So I want to extend the purchase of Great Britain pound from you. In this case, what happens? Again, the same problem faced by the banker. So the banker has to deliver. The banker has a Great Britain pound in their hand to deliver for you, but you say I don't want. So if you don't want, then it will be saleable in the market. The value being 92.50. So 92.50 at the value, it is going to be saleable in the market, and the original value is going to be cancelled. The difference between these two is the gain is also going to be given to you only at the rate of -20. And existing order is cancelled. Existing forward contract is cancelled, but anyhow you want to take up 1 month later, right? So again you have to enter into 1 month contract on the date. So 1/10/2021 1 month contract will be entered. By the time 92.90 will be the rate. So you have to buy fresh one for 92.9 for 1 month forward contract. Is that okay? See, and honors the contract on 1/9/2021. See, actually, I have entered into a contract with you to deliver on 1/10/2021, but 1 month ahead itself, I come to the bank and I demand, sir, can you make the delivery today itself rather than 1st October? Rather than 1st October, I need to take up in September itself. The banker says, okay, there will be charges accordingly. See what happens now. Now let's see here. I am going to guide you this one. Right. Now, in this case, 1st, 2nd, 3rd over, honors the contract early. If you are coming on 1st September itself, what happens? Actually, there is a purchase amount of Great Britain pound available in the hands of a banker. So banker has to cancel the original one. For cancelling, that's 1 month later, right? So 1 month later it is going to be cancelled. So banker will book 1 month forward contract for 92 rupees. For 92 rupees, is that okay? The original value is 92.30. This is the original rate. Now, if you don't want this one, this will be cancelled. But anyhow, you are cancelling on 1st September itself, 1 month ahead itself cancelling. So the banker will now cancel not by spot rate, but they cancel using the 1st month forward rate. So first month forward rate is 92. If they want to cancel, so 92 will be amount recoverable. 92.3 original rate, now it's only 92. So there is a loss in this case by 30 into 1 lakh. So 30,000 loss is there. Is that okay? And apart from that, you want to get okay, that's all. So you don't do any more thing. Honors the contract earlier. Okay, honors means you want the Great Britain pound immediately to take it up. So by the time a new one will be purchased for 92.05. The existing one is cancelled, but the cancellation not, though you are cancelling, but for a backup plan, 1 month later the expiry date, original forward has no. So that's why it's 1 month forward rate, bid rate is taken. Again, you want today itself. Today itself means today's market rate of 92.05 will be taken. Is that okay? Hope so you could understand the E. Cancels earlier. On 1/9/2021, you come and cancel immediately. So if you cancel immediately, the same will be happening here. So 30,000 loss is there, but you don't book any more contract because D is honoring early, E is cancelling completely. Cancelling completely, honoring early means You are cancelling the original one and booking a new one. In the case of cancelling earlier itself means it's only cancellation. By the time it's only 92, 92.3. The difference between these two is the loss, so overall loss being 30,000 rupees. And extends the contract for 2 months on this date. So on 1/9/2021 rollover happens. He extends for another 2 months. What happens? In this date you come and extend for 2 more months. And existing forward contract will be cancelled. For cancelling 1 month period is there. So 92 will be taken. So 92 and 92.3. The difference between these two, 30,000 is cancelled. And you are extending for 2 months means 2 month ask rate will be booked now as a fresh one. So 92.70. Now rework out the same above problem as selling Great Britain pound instead of buying. Instead of buying, if it is going to be the selling, I am getting any Great Britain pound sometimes later. So as I am getting sometimes later Great Britain pound, I don't want that. I want only rupees. So I want to sell the Great Britain pound for cash. I approach the banker, so I am in need of cash 3 months later by giving the Great Britain pound. So immediately banker will help me out to resort that. So in that case, we rather than taking the 92.30, 91.90 will be taken. That's all. So those are the cases you have to keep in 91.90. Is that okay? We had a ask rate earlier. Now hereafter we are going to take the bid rate. So there will not be more complications here. The same 6 situations also here redrafted. You can easily understand this. Is that okay? This is called early cancellation, early extension, early means cancellation, then extension, early cancellation, early extension. These are the options we have. Is that okay? Now, these are the questions in detail we already discussed, so I skip all those things. Cancellation on all. Right. Let's move on to the FII investments. FII investments. An American investor buys 1,000 shares in a Mexican company at a price of 500 pesos each. The share does not pay dividend. Okay. So 1,000 shares at 500 pesos. 500 pesos. The share does not pay any dividend. A year later, she sells the shares for 550 pesos. Okay, this is what about the purchase price. This is purchase price, this is sale price. Already we have seen similar illustration. The exchange rates when she bought the stock being 9.1390 per peso. So to convert that to dollar, you have to divide this by divided by 9.1390, and this will be divided by 9.50. Is that okay? How many dollars does she invest? Very simple. So the number of dollars she invested is in terms of dollar after converting. Okay, 54.571 per investment, per share basis it is calculated, right? And on withdrawal it is 57.38 after converting that, and the difference being 3.18 is the profit. Actually, if you directly see 500 rupees becomes 550 means 50 rupees gain, otherwise 10% gain. Because of conversion rate difference, we are getting only 5.82%. So 3.18 is a gain for your investment of 54.71 in terms of dollar. So 5.82 is the gain for you. The original gain 10% is reduced to 5.82 is just because of the conversion rate changes. Conversion rate changes. Is that okay? Now, we'll move on to the next concept called interest rate parity theory. Interest rate parity theory. Is that okay? In interest rate parity theory, the future value is adjusted because of the interest rate only. Let us brief with an example here. The risk-free rate of interest for 6 months T-bill in India is 10%. 10% per annum means 6 months it is 5%, right? And the risk-free rate of interest for 6 months US bond being 4%, it means 2% per 6 months. Spot exchange rate being rupees 50 by 1, rupees 50 by dollar, right? $1. This is the spot rate. And is the forward rate in premium or discount? Very simple. So home currency is this one. Numerator is the home currency, denominator is the foreign currency. In numerator, I am going to apply the home currency rate of interest. In denominator, I am going to apply the foreign currency rate of interest, right? So otherwise, you have to add 5% and denominator 2% will be addable. So after adding that, the 50 with the 5% calculate interest for that and add with that, so which is nothing but 50 into 1 plus I. Okay, So principal into 1 plus I is the formula, like, right? So 50 into 1 plus 1.05, if you multiply the value being 52.5, and in denominator 1 into 1.02, 1.02. Otherwise, if you divide this, the final answer being 51.47 by 1. It means every dollar costs me 50 today, but 1 year later the cost being 51.47. So automatically what happens? Dollar is in premium, and rupee is in discount. Remember that. Okay. Remember that the country where you get more rate of interest and their currency will be depreciated. The country where the dividend rate is, means the interest rate is lesser, their currency value will be appreciated. As it is very clear, Indian currency has more rate of interest, so definitely this will be depreciated, this will be appreciated. Okay, that's all. Now, here the one more question is also asked. What is the rate of interest in India? Assume forward rate is 51.47 and the rate of home currency is not given. You are aware about that spot rate. 50 by 1 is the spot rate, and you are multiplying with 1 plus rate of home currency divided by 1 plus rate of foreign currency is equal to forward rate. This is nothing but spot rate. This is equal to forward rate. Is that okay? Now, so the formula is drafted this way. Okay, 51.47. It's how it is given. Assume that it is given. Otherwise, forward rate is equal to spot rate into 1 plus rate of home currency, so foreign home currency divided by 1 plus rate of foreign currency. That's how you can draft the formula here. Okay, so spot rate here being 50 rupees into the 1 plus R I have to calculate. Okay, home currency should be calculated. 1 plus RF, which is 2% is assumed to be given, so 1.02 is equal to 51.47. So you can find out the rate of interest in the home currency by this way. Okay, 51.47 into this value goes to the opposite side as an inverse multiplication, so 1.02 divided by 50, and here plus 1 is there to transfer to the opposite side, it becomes minus 1. The final value being rate of interest 5% per 6 months or 10% per annum. We get that one. Whatever the number is given, so you can arrive the other number as a missing data here. There will not be any complications. Is that okay? Now, the United States dollar is selling in India at 45.50. With the interest rate for 6 months borrowing in India being 8% per annum and the corresponding rate being 2% in US. Do you expect the dollar to be at the premium? Yes, of course, because in US the rate is lesser and here in India the rate is higher. So the similar illustration, so I can skip this. Okay. Now the third question, one of the beautiful questions we have seen in detail along with the concept lecture, so you can go and watch that one. So here only you are going to find out the missing data, like the same formula will be there. Forward rate is equal to spot rate into 1 plus rate of interest of home currency divided by 1 plus rate of interest of the foreign currency. In the first case to calculate A, okay, A is nothing but forward franc per dollar. So forward rate is going to be calculated. So for calculating the forward rate, how do we get spot rate? Okay, spot rate is 7.05. Okay, multiplied with what? Rate of interest of home currency, rate of interest of the foreign currency, so that you can find out the forward rate easily. The same way you have to calculate the B, C, D and F, E by applying this formula, so it's pretty simple. Is that okay? Upon payment of shoe company will convert the Dutchmark to dollar. Okay, so they have to convert that Dutchmark into dollar. The present spot rate of Dutchmark being 1.71 per dollar, whereas the 90 days forward rate is 1.70. You are required to calculate and explain. Okay, if shoe company were to hedge its foreign exchange risk, what would it do? What transactions are necessary? For hedging, okay, for hedging they can enter into the forward contract. Spot rate is this one and forward rate is this one, so they can enter into the forward rate. So 1.7 will be the dash mark per dollar. So as it gets 50,000, so 50,000 divided by 1.7 will be the amount recoverable in case of hedging into the forward contract. Is the Dutch mark at a forward premium or a discount? $1 is 1.71 currently, and later it is 1.70 only per dollar. Is that okay? So the dollar is now can be purchasable at lesser rate in the future. It means the Dutch mark is in premium. Dutch mark is in premium. What is the implied differential in interest rates between the two countries? What is the difference rate of interest? The difference rate of interest is nothing but the difference between these two values. Right. So 1.7, 1.71. So the base is 1.71. So this is for 3 months. For 1 year, you can multiply with the 12 by 3 to make it for 1 year's value, which is 2.34 is the differentials in rate of interest. It means in German, the rate of interest is lesser by 2.34 compared to the dollar rate, right? Covered interest rate arbitrage. So already I told you the forward rate is equal to, so spot rate into 1 plus rate of interest of home currency divided by 1 plus rate of interest of foreign currency. By doing this, you will be getting the forward rate. Forward rate. Is that okay? So in case of covered interest rate arbitrage, I am transferring the entire block to the opposite side. Okay. Then F into 1 plus RF divided by S. This is called covered interest rate arbitrage. 1 plus rate of home currency should be equal to 1 plus rate of foreign currency into forward rate by spot rate. If these two are matching, we don't have the chances of arbitrage profits and losses. If this is lesser, home currency value is lesser, then definitely home currency rate of interest is cheaper. So you can borrow in home currency and invest in foreign currency. Definitely you can make a profit nicely. In other way, that this will be higher, means home currency rate of interest is higher than this one. So you can borrow here, foreign currency you can borrow and invest in home currency, it will be cheaper. Is that okay? Hope so you could understand. That's how the covered interest rate arbitrage can be drafted. 1 plus rate of home currency should be equal to forward rate divided by spot rate into 1 plus rate of foreign currency will be the formula here. Right. Now we'll see some illustrations for covered interest rate arbitrage. Currently the spot exchange rate being 1.5 dollar per sterling. So 1.5 per sterling, dollar by sterling. Is that okay? And the 3 month forward exchange rate being 1.52. So 3 months later it is 1.52 by 1. The 3 month interest rate being 8% in US and 5.8% per annum in UK. Assume that you can borrow as much as $1.5 million or sterling 1 million wherever you want to. Either you can go for borrowing dollar or sterling. Determine whether interest rate parity is currently holding. So for the interest rate parity, the formula is this one. If I calculate, then this will be 1.02, this will be 1.028. So not matching. As it's not matching, is of course this is costlier. So borrow here and invest here. Borrow here means home currency. You have to borrow dollar. Home currency, you are talking about dollar, right? So borrow in dollar and invest in sterling so that you will be making nice profit. So borrow in dollar means you are going to borrow this much of money. So as you are borrowing 1.5 million in dollar, convert the dollar into sterling at the conversion rate applicable currently. The current conversion rate being 1.5. If I convert that, then I will be getting 1 million sterling. Withdraw investment in sterling with the interest. So after 1 year, it may be around what's the period? 3 months period. After 3 months, you can withdraw with the rate of interest of 5.8% because the investment is made in sterling, right? Then sterling rate of 5.8 will be applicable. That too you have to calculate for 3 months. So into 3 by 12 it can be applied. 5.8% into 3 by 12. If you calculate that interest is 14,500 is added with this. So the withdrawal of investment will be sterling 1.0145 billion, million. Convert again sterling into dollar at the forward rate of this one. So 1.52. If you convert that, so I will be getting 1.542 million. And you have to repay this borrowing. The borrowing is carrying at the rate of 8% interest, right, per year. So 2% will be now leviable for the 3 months period. So 3 months period, 2% being 30,000. So 1.53 million will be the payment, where we already have 1.54 to almost 12,040 will be my revenue because of this arbitrage. If these two are matching, definitely you don't get such a benefit here. So that covered interest rate arbitrage formula is more than enough to determine where you can borrow and where can be invested. It's very easy. Is that okay? Hope so you could understand. Now we'll move on to the next illustration, question number 2. And here interest rate for 3 months US and Canadian dollar, Canada are as follows. Now what happens now, borrowing interest rate is different, the investment rate also different, right? For the borrow in US dollar, the rate of interest being 4%, and the investment in US you will be getting only 2.5%, and Canada also 4.5 and 3.5. So such a problem arises. So we have two different rates. How can we then proceed? Okay. Now the current bid and ask rate is also given. Current the 3 months forward current rate is also they given. So for forward, so forward bid rate being 1.255 and forward future rate being forward rate for ask being 1.260. Advise the currency in which the borrowing and the lending for 3 months need to be done for US company. Is that okay? Now we have to take one of the values here for IRP calculation. Of course, it cannot be immediately guessed. You can guess, that's all. But anyhow, I am using the interest rate parity theory here. As per that, 1 plus RH, or rate of return or rate of interest in the home currency, is equal to 1 plus RF, rate of interest of the foreign currency, into forward rate by spot rate. And here we have been given two rate. What can we take? Either we can take the investing rate or borrowing rate. One of the rates can be taken. So for the understanding purpose, I am going to take the investing rate here. So investing rate in Canada being home currency, right? So you are in Canada, like we are assuming, because here the value being Canadian dollar divided by dollar is given. So the home currency is the numerator currency. As the numerator is the Canadian dollar, I assume I am in Canada. So Canadian currency will be considered as home currency, and Canadian rate will be 3.5%, and this is per year. So per quarter, it may be calculated by dividing the yearly interest rate by 4. And similarly, for foreign currency also, I have taken 2.5%, that the US interest rate divided by 4 is applied, and by applying the same logic, I got the value this way. Not matching, that too, this is better rather than this one. So as in this, RF will be better, so you can invest here and you can borrow here. So for borrow in home currency and invest in foreign currency. Is that okay? Borrow in home currency, Canadian dollar, invest in dollar, foreign currency will be better. So the same way we can rework out, but the point to be noted here is you are borrowing in Canadian dollar, right? And you are investing and converting that Canadian dollar into dollar and investing in dollar, right? As investing in dollar, 2.5% will be taken. And while repaying the borrowing, what happens now? You have to repay with the borrowings rate. So 4.5% will be taken. Mind that. Borrow in one currency, convert the currency and invest that, and withdraw the current amount invested along with the interest, convert it back to the original currency, and later repay the original borrowings with the converted amount. If there is any plus or minus, that will be the profit or loss. That's how we can get it, right? Same way in question number 3 also you can work out that. Okay, IRP. So this is asked in CMA final, so there will not be any complications, right? Question number 4 is also similar one, but what did I do here is I am approaching the trial and error method. So earlier case I didn't use the trial and error method. I have the interest rate parity theory, but rather than you can use interest rate parity theory, you can assume blindly that you are borrowing dollar and investing in other currency, and other way you are borrowing the other currency and investing in dollar. If you rework out that way, in first scenario there is a loss, in the second scenario there is a gain. So we have to go for this option. That's why you can choose one of the two options. You borrow in dollar and invest in rupee, and or you borrow in rupees and invest in dollar. That's how you can convert that. Okay, in both options, if you verify, one of the options will be definitely giving you profit. So there is no any profit or loss as per this calculation. So what can we do? Then there is no arbitrage possibilities exist. Is that okay? That's what about the fourth question. In fourth question, I am not using the IRP, interest rate parity theory is not using. I am using just comparison. either this method or that method. Now we are going for the purchasing power parity theory. Under purchasing power parity theory, the same way will be there, and where 1 plus rate of interest of home currency, 1 plus rate of interest of foreign currency was taken in the case of interest rate parity theory. But in this case, we are not going to take the interest rate parity theory, but here we are going to take the inflation rate. And so inflation rate in the home currency, inflation rate in the foreign currency will be taken. Is that okay? So rest of the things are same. Similar to the purchasing power parity, means interest rate parity theory, we have purchasing power parity theory. As per the purchasing power parity theory, forward rate is equivalent to this one. Is that okay? The way how we have seen that interest rate parity theory, the same way will be applicable here also. But rather than interest rate, we are going to take the inflation rate. Rest of things are similar here. Right. A television in US costing $500. The same television is in German 725 euro. So 725 euro in German and $500 in US. What is the spot rate between euro and dollar? So euro and for dollar spot rate can be calculated by this value. This is called purchasing power parity theory. So as per this one, you can get the value easily. Is that okay? What is the spot rate between euro and dollar? So I'm going to consider the dollar being foreign currency, and then the value being 1 point something, right? So 725 divided by 500, the value being 1.45. Can we do it in inverse way? So dollar by euro, yeah, of course you can do that in inverse way. Okay. Now that time the value being 0.6896 will be the answer. Is okay, inverse of that. Now in Australia, cricket basketball for Australian dollar being 40, while in India they sell for only 1000 rupees, means 1000 rupees for $40. That's how you can think over. So then it will be 25, right? Spot rate being 25 rupees. That's how we got it here. And according to the theory of purchasing power parity, what should be the rupee by according to Australian dollar? So we got it now. So rupee should be in the numerator, Australian dollar should be the denominator. No problem in that. If the price of the cricket bats in Australia goes up to Australian dollar 44 each in 1 year, and then the price of cricket bat in India goes up to 1074 each. See, currently it is 1000 by 40, and later it becomes what? 1074 by 44, right? Now, what is the 1 year forward rupee and Australian dollar in rate? So very simple. This will be 25 and this will be 24.41. It means Australian dollar is depreciating. Australian dollar is depreciating. Is that okay? Now, in question number 3, the current exchange rate Yen 122 per dollar. So Yen by dollar is equal to 122 Yen will be payable per dollar. If inflation rate in Japan is 2% and then that of USA being 3%. So in numerator, Japan inflation rate will be used, and denominator US inflation rate will be used, and calculate the exchange rate a year after. So very simple. So that value being 120.82. As the inflation rate in Japan is lesser, then their value will be strengthening, and then the currency of dollar will be depreciating, right? Weakens. So it's very simple, right? Now let's move on to the question number 4. In question number 4, you are told that spot rate being $1.65 per sterling. The expected inflation rate in UK and USA for the next 3 years are given. Next 3 years. So US inflation rate is this one, UK inflation rate is this one. Calculate the expected dollar by sterling after 3 years. So you have to multiply with the inflation rates in dollar in numerator, 1.02 into 1.025 into 1.02, and in denominator you multiply this one. So you will be getting the final conversion rate will be 1.602. Now Fisher's effect. As per the Fisher's effect, you have to remember this one. That's all. It's not more than that. You can apply this one. All the logics were already discussed in the concept class. So as in the 11th hour lecture, I am going to just make you understand the formula. That's all. So rate of interest in home currency, rate of interest in foreign currency will be equated with the inflation in the home currency, inflation in the foreign currency. So you can have this equation as being the Fisher's effect. Ascertain the expected future spot rate after 1 year as per the purchasing power parity for Australian dollars in UK. Given the following information, inflation rate in Australia being 3%, current spot rate being sterling 1 is equal to Australian dollar 2. So Australian dollar divided by sterling is equal to 2 by 1. Okay, risk-free interest rate in UK is 9%, and while in Australia it is 7%. Australia it is being 7%. Okay, now what we have to do, as per the purchasing power parity theory, we have to find out that. So you have to get the 1 plus rate of interest in Australia divided by 1 plus, not rate of interest, inflation, because I am going to use the purchasing power parity, not the rate of interest rate parity. So inflation of the Australia divided by 1 plus inflation of the UK. Is that okay? Now the inflation rate in Australia is given, so 1.03 will be taken, and inflation rate in UK is not given. So if you are able to find out that, then you will be finishing the value to find out the forward rate here. Now to find out that, so this is the formula you are going to use as per the Fisher's concept here. 1 plus the rate of interest of home currency. The rate of interest of home currency, your home currency is Australian currency, which is 7% should be in the numerator. Okay, which is the home currency here. Okay, Australian dollar is the home currency, right? So, but in this illustration, they have assumed Australia being foreign currency. Okay, in UK for Australian dollar in UK, so sterling by Australian dollar is the correct one. So then Australian dollar should be in the denominator. For that it is 7%. For UK it is 9%. So in numerator, for home currency rate of interest, in denominator foreign currency rate of interest is used. In denominator we have been given the inflation rate of the Australia, but we need to find out the inflation rate of the UK. So by solving this as a missing data, we can find out the inflation rate in UK, which is 4.93. I can now substitute that here in this case 1.0493. If I substitute, then I will be nicely getting the forward rate here, which is Australian dollar by sterling is equal to 1.9646 by 1. This is called Fisher effect. Is that okay? Now, foreign exchange risk. We have translation exposure, cash exposure, transaction exposure, operation exposure, and economic exposure. These are the exposures we have. How do we now hedge our exposure? So we have choices of forward contract, future contract, options contract, and money market hedging. So these are the 4 options we have predominantly. Apart from these 4 options, we have the other alternatives also. If you are able to understand all these things, you can nicely plan to hedge your position from the risk, right? Now let's see the hedging forward. So we are going to discuss the hedging forward here. As per the hedging forward, it's nothing but I am going to enter into the forward contract to plan myself. That's how the US firm is scheduled to receive Canadian dollar 1.6 million payment from a Canadian firm in 90 days, and the 90-day forward rate is now $0.6 per Canadian dollar. What should the US firm do to hedge the transaction? So US firm is going to receive the Canadian dollar. If the rate goes down, then that will be shocking, right? So how do they manage? They can enter into the forward contract. The forward price is 0.6. So by entering into the forward contract, they are able to get nicely the same amount without any variation. Whatever the market rate may be, we don't bother about that. Is that okay? So 1.6 million Canadian dollar per Canadian dollar will yield me $0.6. In the later period, exactly by the end of the third month, it may be around rather than 0.6, it may be 0.5. 0.5 means I will be losing, but I enter into the forward contract. There's a guaranteed amount payment for me because of entering into the forward contract. Is that okay? Similarly, in the case of next illustration, ABC company has taken a 6 months loan from the foreign collaborators for US dollars 2 lakhs. For US dollars 2 lakhs. Interest payable on maturity is at LIBOR plus 1%. Current 6 months LIBOR is 2%. Then 2 plus 1, 3% is the interest. As we have borrowed 2 lakhs US dollar, 3 months probably under maturity period, we have to pay along with the interest rate also. And all these things are all about 6 months, right? So 6 months means we have to calculate interest at the rate of 1.5%. 3% is per year, so 1.5% per 6 months you have to pay along with. So along with that, the rate being 3,000, I think so. So 2 lakhs with this, the overall amount to be repayable is 2 lakhs $3,000, right? Now exchange rate with their bank elicit the following information. Currently the US spot rate, US dollar 1 is equal to rupee 48, and 6 months later this will be the rate. So definitely I am able to freeze myself by entering into the forward contract means I have to enter into this contract. So 48.4575 is the rate applicable for me for the conversion purpose. So I have to multiply this with the rupee term in the forward value. So 48.4575 will be the value. So my loan commitment by the end of the period is 96,36,873 in terms of rupees. If I am not entered into the forward contract, by the time the US dollar may be different, so I have to face the consequences, right? What would be their total commitment in rupees if they enter into a forward contract? This is what about their total commitment if they enter into the contract. Well, will you advise them to do so? Explain, giving the reason. Yes, of course. By advising them to go for forward contract, they will be now freezing at what value they are going to settle the loan. Yes, there will be problem here. And if the expectation is the dollar depreciation, what we can do? If the dollar is depreciating, then we are pretty happy. As the dollar is depreciating, the in cash requirements, rupee requirement will be lesser for settlement of loan by the time you don't enter into the forward contract. But if we expect the dollar is appreciating, then it will be a loss for us by paying more dollar by converting the rupees, right? So the dollar will be the same, but for purchasing the dollar, we have to pay more rupee. So there will be loss. Then we have to definitely enter into the forward contract. Is that okay? Number 2. Now, next one will be a company operating in a country having the dollar as its unit of currency has today invoiced sales to an Indian company. The payment being due in 3 months. 3 months from the. This is also similar one, so you don't need to worry about that. Spot rate. If you hedge, if you don't hedge, what happens? So in these 3 angles, we have to answer that. So there will not be any problem in that. Now, we are going to introduce the money market hedge here. Okay. Forward along with the money market hedge, especially in the case of receivables. I am supposed to receive this. See, MN UK has a substantial portfolio. So MN is in UK. Has substantial portfolio of its trade with American and German company. In America as well as in German, they have the contract. It has recently invoiced a US customer a sum of rupees $5 lakhs. So 5 lakhs rupees worth goods invoiced, and for that UK will get 5 lakhs rupees, right? 5 lakhs dollar. Receivable in 1 year's time. MN Finance Director is considering 2 methods of hedging the exchange risk. One is borrowing present value. So you keep it pending. Entering into 12-month forward exchange contract. Very simple. So you can enter into the 3 months forward contract. 12-month forward contract, exchange contract with the company's bank to sell the $5 million. So they are anyhow going to get $5 million. They can, what they can do is very simple. They can enter into the forward contract to convert that dollar into UK sterling. So for that they are choosing the 12-month forward price. The 12-month forward price is this one. So they will be getting this amount guarantee 1.6125. Okay, you have to divide that, right? Okay, you have to divide this. So 1.6125 is the denominator value. Guarantee you will be getting sterling 3,10,078 78. Okay, you are getting so much of money if you are entering into the forward contract. Yes, of course they have the method one also, the other option. The other option is pretty different. Let me explain that in detail. Right here, what happens now? You have the steps here. I just explain the steps one by one here. Anyhow, I'm getting 5 lakhs rupees 1 year later from a company in US, right? So what can I do is I can borrow today itself from a banker in UK the present value of 5 lakhs rupees. So I borrow present value of 5 lakhs rupees in UK today itself. For borrowing in I'm borrowing in USA. I have to pay interest rate of 3.5%. So I'm discounting the 5 lakhs rupees with the 3.5% rate of interest. So I'm getting $4,83,092 today itself, and I convert that into sterling today itself. So by converting, I'm using the spot converting rate 1.6355. After converting, I'm getting the sterling 2,95,198. In case of forward contract, I'm getting 3,10,078 by the end of first year. But in the case of money market hedging, I'm getting 2,95,198 sterling today itself. But we cannot compare because this is today's value, this is first year ends value. So you have to convert that to the first year's value. We assume that the amount so converted in the UK is going to be invested in UK. That UK investment will fetch 4% return on this. So along with that 4%, we'll be getting 3,07,006 sterling here. Anyhow, this money market hedging will be giving me lesser income than the forward hedging. So we have to choose forward hedging option in the case of forward or money market hedging. So one of the nice example to make you understand the difference between forward hedging related to the payables here. A US company purchased several boxes of watches from a Swiss company for 3 lakhs francs. This payment must be made in Swiss francs 90 days from today. The following quotations are expectations exist. 90 days US interest rate and Swiss interest rate. So these two interest rates given, and 90-day forward rate as well as spot rates given. What the company be better off using the forward market hedge or money market hedge. So again the same way, but it is all about the payables. In the case of forward hedging, they can freeze the payment with this value $0.4. Is that okay? Now 3 lakhs francs is going to be payable, and you need the francs, means you have to convert the dollar. So $1, 1 franc will fetch me 0.4. Then 3 lakhs into 0.4 will be the outflow if I enter into the forward hedging. But if I want to enter into the forward market, money market hedging, as it is a payables 3 months later, right? So 90 days, right? 90 days later, I have to make the payment in franc. Then what can I do? I can invest the present value of 3 lakhs francs today itself. Right? Is that okay? So the present value of 3 lakhs franc is going to be invested today itself. Then the rate of interest available in Swiss being 12% per annum. So this is per annum. Per quarter will be 4% in US and 3% in Swiss. So as I'm going to invest in Swiss bank today itself, this much of amount, which is nothing but present value of the amount requirement by the end of third month. By the end of the third month, this amount together with interest could become 3 lakhs. That 3 lakhs is enough to settle the payment, right? Whatever the investment I'm making here is not possible unless I have the currency today. So I have to borrow the same amount in US. So borrow the dollar and invest in borrow dollar for the investment in Swiss franc, right? So for borrowing this amount I have to borrow, right? For borrowing this amount I have to borrow in terms of dollar based on the spot rate. So I'm going to convert that to the spot rate of $0.404. So then it is converted into dollar, right? Is that okay? So much of Swiss franc is there. Okay, this is Swiss franc. Make a correction in that. So I invested the Swiss franc here. After converting into dollar, that dollar will fetch me 4% interest per quarter. So with the 4% interest, my money will grow up to this. Otherwise, my original payment will be this one. So the borrowing in dollar will be repayable along with the interest by this much money. But if I enter into the forward contract, I may make a payment of only 1,20,000. So this is much cheaper than that one. So we have to go for forward hedging rather than money market hedge. So you can now understand the difference between money market hedge and forward hedging. And again, forward and money market hedge for the payables, already we have seen similar illustrations. So I skip this. And receivables and payables both will be available in the same illustration. A part is for receivables, a part is payable for the additional learning, right? Now we will be in future hedging. It's an organized one, and the lot size is also predetermined. We cannot cook our own, right? In forward hedging, it's a tailor-made like, and in case of future hedging, it's a ready-made like. The size will be already available. You cannot modify that. For imports from UK, Philadelphia Limited of USA owes sterling 6.5 lakhs to London Limited, payable on May 2021. It is now 12th February 2021. The following future contracts where the contract size is 62,500 per contract size. So in case of forward contract, we usually prepare exactly, because that's a tailor-made, it's a ready-made. Ready-made means we have to make ourselves fit for that. It happens most of the cases, right? Okay, are available on the Philadelphia Exchange. Illustrate how Philadelphia Limited can use the futures contract to reduce the risk if on May the spot rate is $1.503 per sterling and in June Futures are trading at $1.512 per sterling. The spot rate on 12th February is $1.485 per sterling. Right. Calculate the hedge efficiency. How do we do? We can assume that it is going to be payable today itself. If it is going to be payable today itself, this is the value we have to offer. 6.5 lakhs sterling multiplied with the spot rate. So you have to pay this one. This is the current payment outflow in terms of dollar. And what you can do is you can remain unhedged. Unhedged means by the time of expiry date, what is the rate applicable? That rate will be used for payment, right? And June futures are trading okay. Then the May, the spot rate, it is predicted one. We cannot assure. So if it is being 1.503 as per my assumption, this will be the outflow, right? 6.5 lakh sterling is multiplied with 1.0503. So this will be my outflow. So paying today will be better, but anyhow, why do I want to pay today itself if I am given 3 months term of credit? So we can extend. So because of this one, our exposure increases from this to this, right? So almost 11,700 rupees we have to pay extra in terms of dollar because of remaining unhedged. Rather than paying today, we postpone the payment. By postponing the payment, by the time of payment, the conversion rate is also different. Because of that conversion rate, I have to pay more money for the 3 months period. So $11,700 will be payable excess. Otherwise, what can I do is payable on May 2021 with the hedging. So here May hedging being $1.49 per sterling as per the current futures. Anyhow, 62,500 will be the lot size. I need 6.5 lakhs, right? 6.5 lakhs divided by 62,500, it's approximately 10. So what can I do is I can enter into the 10 contract and remaining may be unhedged. So to the extent of only 10 contracts is going to be hedged or as per the future contract. So 6,25,000 sterling is hedged with the May future. As per May future, I had to pay only 1.49. So this will be the outflow for that. For the remaining unhedged portion, another portion being 6,50,000 minus 6,25,000. 25,000 remains unhedged. Because the lot size is odd lot size, we cannot manage that. As the lot size is odd, what we can do is very simple. To the extent possible, round off to the closer number can be hedged, remaining remains unhedged. As the remaining 25,000 remains unhedged, by the time of payment, the spot rate is 1.503. That's how we assumed. So I am now multiplying this with this value. So this will be the payment for the unhedged. This is the payment for the hedged one. So overall payment for the entire 6,50,000 is this one. So which is nothing but $9,68,825. If I don't hedge myself, the payment being 9,65,250. Because of May month future hedging, I may pay only $9,68,825. Otherwise, I am paying around $3,575 excess increase in exposure. So if I am keeping unhedged, then my exposure is 11,700. If I am hedged with the future options, especially May future options, my hedging means exposure increases only $3,575. So this is better than that one. Now remember here in this illustration, we have been given June future also. If the June future is given, what can we do? That's the beauty of this illustration. Because anyhow, you are going to make the payment only in May. Though you are making the payment in May, why do we get the questions? Why do we have the futures for June, the 1 month after June? So that's a beauty. So I'm going to explain that. Now in this case, now I'm going to enter into not May. I'm going to enter into the June hedge, June 2021 hedging. Is that okay? So 1 month later, June hedging. Okay. So how many contracts I can enter? Anyhow, 10 contracts I can enter. If it is being June contract, the amount payable being this one, right? Anyhow, the actual thing is I am not hedging myself for the exact requirement. Is that okay? Exact requirement. But remember, I enter into the June contract. By the time it is 1.496. But when May comes, the real payment date comes. By the time I am not in use of this June at all. What can we then do, sir? That can be saleable in the market now. So The June futures are trading at 1.512 by the time 1.512. You purchased a June contract in February for 1.496 in May. This is in February, you purchased in May. The same June future is traded at 1.512. You purchased at that and now you can sell it for this trade. So the difference between these two is your gain. How many contract you have? 10 contract. Every contract is 62,500. So the overall size being $6,25,000 multiply with the gain. So you are saving around 10,000 rupees. Anyhow, payable in May 2021 as unhedged. As you are making the payment, you have to make this payment, right? So $6,50,000 is going to be paid spot by the time. So at 1.503, you are going to make the profit. So here what happens now? Original payment is unhedged and paid as per the spot rate applicable in May 2021. But you purchased a June future in February and you are selling the same June future in May. By doing this, there's a profit out of it. So this is the profit, this is the cost. If you offset the profit with this payment, your net outflow will be only $1,700. See, if you are paying today, this will be the value. If you are unhedging, then you are paying 11,700 more. If you are hedging with the May future, you are paying 3,575 rupees, dollar extra. Rather than enter into the June future and remain unhedged. Because of entering into the June future, by selling the June futures in May, you are making a nice cash inflow of 10,000. As you are keeping the May settlement unhedged, you have to pay as per the spot rate applicable by the date. So from the payment, you can adjust this revenue. So your net exposure being 1,700. So among the three options, among the unhedged option and hedged option, with the May and hedged option with the June, the last option will be better, 1,700. Usually, if you are unhedged, then your exposure being 11,700. Because of this exposure, you are paying only 1,700. It means your exposure is reduced from 11,700 to 1,700. So much of reduction is there. So then, what is the reduction in overall in terms of percentage? Then that percentage is 85.5%, which is called June future, which is called hedging efficiency. Hedging efficiency is nothing but if it is unhedged, what is the cost? If it is hedged, what is the cost? Find out the difference, and you can represent the difference in the term of percentage. Then they will get the value here. Is that okay? Now we'll be moving on to the option hedging. We are moving to option hedging. Right. So you can go for either call option or put options like that. Here also we have the option hedging. An Indian exporter has sold handicraft items to an American business house. The exporter will be receiving $1 lakh in 90 days. So what can we do? Anyhow, we are receiving the dollar, right? As we are receiving the dollar, we need to enter into the call option. We can enter into the call option, right? Premium for a dollar put option. So here put option is also there. Okay. So not call option, put option. I have to, I need to have the option to sell the dollar I received, right? So I have to enter into the put option only. So the put option with a strike rate of 48 per dollar in 90 days, and then the premium being 1 rupee. The exporter anticipates that spot rate for after 90 days could be 46.50 only. Okay. See, this is what about the put option exercise price and the spot rate in the market being only 46.50. What happens here? Should the exporter hedge its account in the option market? Now, if you don't hedge, unhedged, what happens? 1 lakh by the time $1 is equal to 46.5. So you will be getting only 46.5 per dollar, means you are getting 46,50,000 rupees only. Otherwise, you can enter into the option hedging. If you enter into the option hedging, you will be getting 48 rupees. But anyhow, you have paid 1 rupee premium. So you will be getting net of premium being 47 per dollar. As such, now you are getting $1 lakh. So $1 gives you 47, means you have to multiply 47 with $1. $1 lakh dollar. So 47 per dollar into 1 lakh, you will be getting almost 47 lakhs. So you have to accept this. You have to accept this. If it is unhedged, you will be getting only 46.50. If you are hedging with the option put option, you will be getting 47 lakhs. If the exporter is anticipating the spot rate being 47.5 or 48.5 after 90 days, 47.5 means 1 lakh into 47.5, 47.5 lakhs will be the revenue. 48.5 means 48.5 lakhs. 48.5 lakhs, still better. In these two scenarios, options should be rejected. So the first scenario where the expiry date, the payment is, the dollar is 46.50 means you can accept. If the dollar price by the end of 90 days is 47.5 or 48.5 means those options are going to be rejected. So what is the scenario for the put options also explained. So this is also one more strategies we have. So we have 4 strategies. One is forward cost strategy, another one is future, another one is money market. Finally we have the option hedging, either call option or put option. You can enter into that. Is that okay? We have the other alternatives also, where we have the leading and lagging payment. If the price is going to be increasing, what we can do? Pay today itself. That's called leading the payment. Lagging, you think that in the coming days the dollar value is going to be depreciating, you have to pay the dollar. So wait for depreciating, so then you will purchase at a lower rate, so you can pay. Lag your payment, delay your payment. So either you can lead the payment or lag the payment to hedge your problem, right? In case of risk sharing and risk shifting, see, I need to get around $1,000 in 3 months time. So I may have the fear that the dollar may be changing its value. Today's value is 15, the tomorrow if it is 40, then I may get only 10,000 into 40,000 rupees only. Today's value is 50, so 50 into 1,000, 50,000 I will be receiving. If the dollar rate is decreasing, then I may be losing, I am getting lesser. Then what can I do? I can make the invoice in terms of rupees. Sir, I will export the goods, sir. For that the payment will be 50,000 rupees, sir. That's all very simple. By converting that value in terms of our invoice is prepared in terms of home currency, that's all. Then automatically the risk is shifted to the other party. Here we are not eliminating, but it's only shifting. And risk sharing, in some extent we will be bear, sir. If the loss is from 50 to 40 means I can bear up to 5 rupees, another 5 rupees you have to share. Then if the risk, because of the risk there is any profit and loss, that will be mutually shared, then it is called risk sharing and risk shifting. These are the components also available. Hope so you could understand. So then we have transaction, translation, exposure and foreign currency accounts also. Is that okay?